to click it.
Good morning, everybody. We're going to get started with this morning's program. The first paper is from Debbie Lucas and Ji-Hee Hong on COVID credit policies around the world.
Okay, thanks very much to the organizers for inviting this paper. So, governments everywhere rely on credit to execute all kinds of policies, but they really accelerated their use as economic stimulus during the pandemic. And so the focus of this paper is to think about these policies which, like traditional fiscal spending, provided incremental resources to households and firms. So this is not all credit policies that happened during the pandemic, but we have a focus on government loan guarantees and direct lending, on large-scale forbearance programs, and also a bit on the regulations that were relaxed to make those programs possible. So I want to emphasize the main goal of this paper was really measurement, which is the question that hasn't been addressed head-on before, which is how do you size these credit programs to evaluate their macroeconomic effects as a complement to or perhaps a substitute for fiscal policies. And so our empirical analysis covers 7 large advanced countries: France, Germany, Italy, Japan, Spain, United Kingdom, and the United States. We focused on those countries not out of preference, but because of a lack of data for many other places. But the coverage is global in the sense that, at least in dollar terms, this accounted for more than 90% of these credit initiatives globally. And so, as I think Corbin will emphasize more, developing countries relied far less on these credit programs, as they relied less on fiscal policy, because it's a luxury of being a first world country that you can respond strongly and countercyclically to economic downturns. And also, actually, in some places, the pandemic was less of a shock than the other problems that they deal with on a routine basis. Okay, so the paper begins with a lot of conceptual questions, and given my short amount of time, I'm going to force myself not to linger on any of them. I think some of them will come up again in the discussion. But as I said, the sizing of these things was our primary question. You know, how do you size credit policies to be comparable to fiscal policies for the purposes of macroeconomic analysis? And the unifying concept that we kind of settled on was incremental resources provided. And we operationalized that in slightly different ways for different credit policies, but that's the unifying concept. And then also in thinking about credit, the question comes up, the size of what? And so our focus is on what I would call the extensive margin effects of credit policies. So the extensive margin is consistent with this incremental resources provided, but the story behind that is, particularly during severe downturns, it's hard to obtain credit. So just the access to the market, that extensive margin, is what's providing incremental resources to firms and households. Now, presumably, some of them could have borrowed anyway and might have, and so to that extent, we will be over-counting the incremental resources, but we're focusing on that extensive margin. The alternative, by the way, is the intensive margin, which would be asking the question, take the subsidies involved in the credit and ask how much people respond to those subsidies in terms of demanding incremental credit. Certainly there's some effect of that, but we think that's second order to that extensive margin effect. Okay, so there's a separate question that comes up with credit that doesn't so much with traditional fiscal policy, which is what's the cost of that credit provision? So with typical fiscal policy, there's not a big issue, because if you hand someone $1, it costs $1 in a government budget. But if you make credit more available, the subsidy cost is really the question, how much resources are the government giving away in order to make this credit program possible? So generally, I think people agree that's the kind of a present value question. So if you make a loan guarantee, what the government is doing is they're absorbing future credit losses, maybe losses that occur years in the future, and they might be receiving some guarantee payments along the way. And so you could call the budgetary cost the difference between the present value of the support that's being given out versus any payments they're receiving in return for those guarantees. And so the bullet there says that we think that these budgetary costs should be valued at market value or at fair value. That's the idea, that the cost to the government is effectively what it would cost them to go out to an insurance company and purchase the same level of assistance from a private company. But in any case, I guess I want to just say that these subsidy costs are often far lower than the incremental amount of principal that's provided, simply because most of those loans they're eventually repaid. So it can, as I'll emphasize later, it can be a kind of an effective, kind of a bang for the buck kind of effect. As far as how governments account for credit support, following what I've said already, the budget should recognize upfront their cost, and then subsequently, it would be good if governments would track their take-up and performance and everything else. In fact, governments account for credit relatively very poorly. It's often off balance sheet with almost no upfront recognition, and then there's very inconsistent reporting of ex post outcomes. Quickly, on the transmission channels for credit policies, we would say that these work like other demand-side policies. Basically, they make more resources available to household and firms or at a lower cost, and it causes them to spend more money, and that has a stimulus effect. I think in the case of credit policy, what's important is there's strong interactions with monetary policy. So for instance, during the global financial crisis in the United States, credit policies, I would argue, reduced the effectiveness of monetary policy because we had credit policies that made it difficult for people to refinance their mortgages at lower rates. And so that was kind of a blockage to monetary policy. Whereas during the pandemic, these credit policies enhanced the low interest rates that came through monetary policy because they made credit so much more widely available than they otherwise would have been. We talk about, but don't do much with multiplier effects. The only thing I'll note is that during the pandemic, as we all know, a lot of money was provided through fiscal and credit policies. People didn't have a lot to spend it on, so they saved a lot of it. So we have this sense that the multiplier effects were probably muted compared to what they might have been during other recessions. Okay. Another thing that comes up all the time are the pros and cons of using credit policies versus traditional fiscal policies, and this is just a quick laundry list. So traditional fiscal policies, I would emphasize transfers, tax cuts have a number of advantages over credit policies. They're certainly much more transparent. I would argue it's possible to target them more tightly. Maybe most importantly, they can reach low-income households and firms that have only tangential connections to credit markets, and so you can't necessarily reach people with credit programs that you can with traditional fiscal programs. And they do generally have a discipline of the budgetary process that is often missing in the case of credit. But the main disadvantage of traditional fiscal policies is just the budget constraint. They cost dollar for dollar what you're giving away. So if you want to do anything on a very large scale, it's going to cost a lot. And so that can make it hard to reach as many people as you would like to, which is, I think, one of the reasons that governments have turned so heavily to credit policies. So just to talk about loan guarantees and direct lending, which in some sense are economically equivalent, they have this advantage of a higher bang for a buck, as I described earlier, because you recover a lot of the money, so it's not quite as expensive. I also want to note that this is particularly important when credit markets are disrupted, because when markets aren't disrupted and people could borrow, in any case, it's going to have much less of a marginal effect. Okay, so the disadvantages of these loan guarantees and direct lending, they can have quite high overhead. They involve bringing in financial institutions. It's hard to reach the targets you want. In the US context, probably the Paycheck Protection Program comes to mind, where they really reached the friends largely of bankers and didn't necessarily get to the firms that really were of most interest for the policy. I'd also note that credit isn't free either for borrowers or the government, in the sense that defaults are very costly. So if you default on a loan, you can lose access to future loans. It's bad. You might not even be able to get a job or a house. So defaults are extremely costly to individuals, and of course it's costly to collect on defaulted loans. Okay. In terms of the forbearance policies, student loan debt moratoria that was put in place in the US. So in the case of a country like the US that has a lot of standing credit programs, particularly for mortgages and student loans, they can get money out the door very quickly in some sense, because they don't require quite low, but they're only going to reach a limited number of people, existing debtors. Another very important issue is a lot of forbearance policies are instituted not with government support, but rather with mandates on the private sector. So they're not transparent. There's hidden taxes, and those mandates can have other unintended consequences. Okay, so let me show you what we did. So all these graphs are showing quantities as percentages of loans to the 7 countries that we were looking at as a percentage of their 2020 GDP. So most of these are actually loan guarantees rather than direct government lending. A lot of this money went to SMEs. Typically, the guarantees fell between, they offered the money for quite a long period of time, so it's really only now that you're seeing what's happening with the performance of some of these programs. So one thing you can see about this graph is that based on reports, which were very useful by the IMF early on, which they called the credit envelope. And we want to emphasize that the amount of money that was made available, the only number that we know of that was available about the size of these programs before we wrote the sequence of papers. And so it really changes your view of things to look at the actual take-up. And then just in terms of the fiscal cost, which is not the emphasis of this paper, but I'll just mention that on average across these programs in our previous work, we found that to be about 37% of the principal extended, so that, that does give you a fairly high multiplier effect. Okay, so credit forbearance policies were holidays from making payments. A lot were for residential mortgages or for small firms to banks. And in this case, we operationalized the idea of incremental resources provided by just trying to add together the number of payments that were skipped. So not rocket science, but also not information that's available. So because, the programs, well, many of the programs were not really reported much anywhere at all, but even for the ones that were, it was kind of sporadic, like, well, this is how many households were served, or, this was the average loan size, but you didn't really know how many payments were skipped. So doing a little bit of back of the envelope exercise, we were able to estimate that, and that was a lot of the blood, sweat, and tears of this paper, although it seems like a small thing. And so these are our estimates. So you can see that the underlying principle on forbearance was actually potentially huge, but if you just measure things in terms of these skipped payments as percentage of GDP, it's actually much smaller for most countries. But interestingly, the 3 places where it was quite significant was Spain, France, and Italy. And just kind of a provocative thing to ask is, were they relying on this partly because they had fiscal constraints that made it harder for them to do traditional spending from the EU, and perhaps that's why. You may be surprised at how small it is in the US because student loans were a big deal and mortgages, but it didn't turn out to be that large. Okay. There were also regulatory accommodations. I'm running out of time, so let me just say that because these guarantee programs and forbearance programs required to write down those loans in the normal sort of way, they probably wouldn't have wanted to participate in the programs. So they changed the rules so that they didn't have to write down these loans where there was forbearance, which might have been reasonable from a regulatory perspective to the extent that the governments were absorbing the risk, but it might have given an overly rosy picture of the what was going on in markets at the time. Okay, so let me use my remaining time to emphasize the results. This is adding together the incremental resources provided across these countries, and there's 2 things I want to point out. One is that when you take fiscal plus these credit support programs plus the forbearance, you get a 50% increase over just fiscal alone. So average fiscal is 14.5% of GDP. When you add credit and forbearance, you get to 22%. So that gives you a sense that there was a significantly larger government footprint in all of these countries, really. Well, not so much in the US, but in many of these countries than if you don't take credit into account. The other thing that's really interesting is that the variance of the amount of assistance is much lower when you look at all these things added together than when you look at individual policies, which makes you think, well, all these rich countries really had the kind of the same sense of what they were able to provide in terms of resources. So we were interested in fact, when you look at those aggregates, are you better able to explain or suggest explanations for macro outcomes than if you just looked at traditional fiscal policy. So this is looking at the relationship between real GDP growth between late 2020 to late 2021. And this is maybe the most striking result, which is when you just look at fiscal policy, the correlation across countries between fiscal to GDP and real GDP growth is rather weak. When you look at the totality of those policies, things actually line up quite nicely. And we cheated and threw out Japan, because if you add Japan into any of these calculations, you lose everything. But Japan is always hard to explain, so we're not going to make an exception here. We're just going to admit that we're throwing them out. Okay. So the other place where we see quite a high correlation generally is between fiscal and savings rates, but we get a better correlation if we include the expanded measure that includes credit and forbearance, a tighter relationship. So it's notable that in all of these countries there was a big blip up in private savings rates, both in 2020 and 2021. And so, there is a stronger relationship there. So I think we'd also hope to find that maybe this would help explain something about inflation differentials, but either with traditional fiscal policy or with the broader measure, there isn't much relationship. Maybe one reason for this is that 4 of the 6 countries on these graphs have a single central bank, so you might not expect to see that much differentiation in inflation. Nevertheless, one could argue that the very high level of resources provided by credit programs further contributed to inflation everywhere. So I think I'm completely out of time. So just to conclude, we find that credit support and forbearance policies injected significant additional funding into advanced economies. And we did not want to restrict this to large advanced economies, but both data limitations and really time prevented us from going beyond that. We hope other people or us will undertake similar analysis for additional countries. For instance, Turkey and Brazil used credit relatively heavily in okay. And then finally, bottom line is advertising that, economists need to give credit policy higher standing than it currently has in macroeconomic analysis. So, we'd argue that it should be elevated to having, to some extent, independent status, which is parallel to monetary and fiscal policies, because the way it's accounted for now, it gets buried. And when it's buried, we can't understand the totality of its effects. So thank you very much.
Thanks, Debbie. The first discussant is Alan Auerbach.
Can I just advance it by? Okay, great, thanks. Let me start my comments by okay, does this no, I'll just hunch over here. Okay, let me start my comments by offering my full-throated support for Debbie's last point, which is that it's important to give more attention to credit policies, particularly when they have, going back to the financial crisis, have been so large. Debbie has a lot to do with making us think more about this, and I really liked reading this paper by Jihi and Debbie. Okay, so let me talk about this issue of where credit programs fit in and how they differ from fiscal policies, and why we should care about the similarities. All right, this must be a magnetic field here or something. Okay. Okay. So to pick up on a point Debbie argued, one of Debbie's points, she argued, well, regular fiscal policies, what you see is what you get. The impact is the cost. That is the cost expressed in budgets is, the amount that we spend on the programs or on the tax changes, whereas credit policies have subsequent pieces, loans with repayments, or even if there's subsidies to the payments or deferral, or there's money coming back, and so there's a net cost which is less than, and possibly substantially less than the impact cost, and therefore the question is how we should measure the size of these credit programs to make them comparable to say traditional fiscal policies. I guess I would push back on this point about the difference between the programs, the budget size, by pointing out that regular fiscal policies have these time profiles as well. To think of one rather trivial example, in 1992, the first President Bush, unable to work with Congress, by executive action, changed the withholding table. And he did this to try to stimulate the economy by basically reducing withholding. So people were suddenly not having as much withheld from their paycheck, and of course they were going to owe more or get a smaller refund on April 15th. Well, that sounds a lot like the way a credit policy works, right? You get money in the short run, you pay it back, and not very much longer run. Now you might say, well, that was a strange policy, and it was, there are not that many examples of that. But it's true for real policy changes too. Think of investment expensing, which was introduced in 2017, or even the bonus depreciation that existed before that. What happens? Well, companies get deductions, so they get tax savings in the short run, and then they get less tax savings in the longer run because the depreciation deductions they would have gotten in the longer run they got in the short run. And so, in fact, from an accounting statement point of view, there are deferred taxes that will eventually be paid. So that timing also looks a lot like a credit policy. But when we account for it, if we do it on a one-year basis, it looks big, and if we do it on a 10-year basis, it looks a lot smaller. And so, in some sense, it's sort of automatically being handled the way you might want to handle a credit policy. But it's true even when enacted policy changes don't have this pattern. I mean, think about when we're doing estimating multipliers using vector order regressions or local projections method. When we're estimating the effects of say, innovation to tax policy or government spending, and we're estimating the ultimate effect, that ultimate effect is incorporating the effects of subsequent induced changes in taxes or spending. And so if we say, well, there was a tax increase this year and that led to subsequent tax cuts, and then we look at the effect over time, we're taking account of all the changes, not just the initial change. And so whether the policy is explicit or implicit, in the case of fiscal policy, we do have not just initial impact effects taken into account. And this would also be true of credit programs. For example, to the extent that changes in, say, suspension of student loan payments during COVID may have led to expectations of further relief from student loan liabilities. So I don't think in that sense that there is as big a difference between credit policies and traditional policies as the authors suggest. But there are other potential differences. So credit policies, and Debbie emphasized this too in her comments, may help relax temporary borrowing constraints. And we think of that as a potentially important role for credit policies and not so much for traditional fiscal policies. But of course, that isn't the only thing that credit policies are adopted for. That may have been the main reason for TARP or programs like that, but it's probably not the main reason why student loan suspension of student loan payments was adopted during COVID. So again, possibly, but not always. What is another reason or another way that credit policies differ from traditional fiscal policies? Also discussed in the paper, credit policies are treated differently in the budget. And indeed, addressing this was, or at least partially addressing it, was a motivation for the Federal Credit Reform Act over 3 decades ago. So the U.S. doesn't account for credit policies simply by treating them as on a cash flow basis, but actually, as in the case of TARP or other programs, calculates a present value cost to the government, either because of subsidized rates or partial loan forgiveness or something like that. Now, the authors argue in this paper, and Debbie has argued forcefully in earlier work, that U.S. policy doesn't go far enough in sort of overstating the present value of future repayments. But the U.S. looks a lot better than most other countries in this regard. That is, we at least make some adjustment for credit policies in terms of pulling them into analyzing the fiscal cost, whereas most countries don't do anything at all. It's just off the books. And that's a problem. Now, the budget treatment also differs, not just with traditional credit policies, but forbearance policies, which in the paper are sometimes collected together with credit policies, sometimes analyzed separately. But forbearance policies can either be adopted through forbearance by the government of things owed to the government, or through basically a forced mandate on private lenders or landlords or whoever it is. That may be attractive from a government's point of view, from a budgetary standpoint, because they may want to play down the size of their intervention. And this is an intervention that's hidden. I mean, the act itself isn't hidden, but the budget cost is hidden because it's an implicit tax, not an explicit one. And there's a typo there that should say they may also appear. Such policies may also appear efficient to governments in the short run. They think, hey, here's a capital levy on landlords or private lenders or some other private entity, and that's pretty efficient in the short run, right? We're just taking money from them and giving it to debtors or renters or some other group. And so not only is it a hidden cost, but it's at least in the short run an efficient cost, apparently. Okay, now let me just say a few words about the paper's findings, which Debbie summarized in her presentation. The credit program impact size varies a lot from the envelope among the 7 countries studied in depth in the paper. And also, interestingly, the credit policies seem to be substitutes in the just mechanical sense, that if you look at how much the size of fiscal interventions varies across countries, it varies a lot more than if you sum together the actual take-up of credit programs and plus fiscal policy, where it's much more uniform across those 7 countries. Of course, we don't know why, at least among these 7 countries. The U.S. relied a lot more on direct fiscal policy. Is that because of budgetary treatment? Is it less advantageous to rely on a credit program when we at least do some accounting for it in our federal budgeting? Maybe, but it's hard to know. It appears, based on the IMF data from which their size of these fiscal envelopes came from, that emerging economies relied less on all policies, as Debbie said, but actually relatively less on credit policies. And we don't have measures of the actual take-up because they only did it for these 7 countries, but if you just look at the envelopes, those are advanced countries. The dark blue lines are the fiscal policies. The light blue lines are the credit envelopes, credit policy envelopes. And you can see the scale on the left as a share of GDP. That's advanced economies. That's the comparable one for emerging markets. I don't have the even less developed countries here. But you can see the second graph is a lot lower. The bars are a lot lower, except for and the thing that's circled there is the aggregate for emerging economies, and you can see that the credit policies are smaller than the fiscal policies there, about the same size here. So just by this crude measure, it does seem that that developing emerging economies not only did less in general, perhaps because of less fiscal capacity, but also did less, even less in credit markets. Maybe that's because of weaker financial structure. I don't know. It'd be interesting to consider. There's a strong correlation between GDP growth and the fiscal and credit policy impact size. Not much of a correlation at all if you just look at fiscal policy size. Strong correlations between increases in private saving and the size of fiscal and credit policies, and no relationship to CPI inflation. Okay. Now there's issues I have to raise with the interpretation of the results. And in the paper, the authors are humble about what one can learn from 7 countries. But I just want to emphasize a few things. First of all, there's the obvious problem of endogeneity. Why are the policies adopted? You can get reverse causality. You adopt a lot of fiscal policy in a bad recession. You just look at the correlation, and you could have a negative correlation instead of a positive correlation. Now they look at the delayed effect on output, only starting in the fourth quarter of 2020 instead of right away when the policies were adopted. But that's a partial solution. And so there's no simple way of doing it unless you have some exogenous driver of policy size. It's a small sample, right? It's a small sample because it took a lot of work to do what they did, and I admire that. But nevertheless, it is a small sample. And the correlate, and I just looked to see, okay, well, are they representative? So I took the entire IMF data set and looked at fiscal policies. And I can only, the publicly available data set just as annual data, not the quarterly data they used in the paper. So I looked at annual 20 to 21 growth and the correlation between fiscal policy size and growth for their countries and for the 31 countries for which data were available for both variables. And it's minus 0.5 for their countries. So it actually, on an annual basis, it's actually not 0, it's negative. And it's plus 0.06 for 31 countries. Okay, so it matters what sample you're looking at, and those 7 countries are not necessarily representative of even advanced economies. Embarrassing to make this point in a group that knows this, but we're probably, if we want to study the impact of one variable on another, we probably want to look at regression coefficients, not correlations. So I did this. I mean, you might say, well, these are only 7 countries. You can't, the empirical evidence is not that impressive. It can't be that impressive. Well, but if you're looking at empirical evidence, you're looking at empirical evidence. So let's look at the regression coefficient. And so I did. And the regression coefficient of fiscal plus credit policy on GDP growth for the same period they're measuring, the same variables, but just looking at the regression coefficient instead of the correlation, is 0.57, marginally significant. It's actually not a crazy coefficient. It's a multiplier of 0.5. We would have expected multipliers to be smaller during this period because of the restrictions on mobility and so forth. So not nutty results, but just something to point out. So let me come back to my conclusions. I think to the extent that my last set of comments suggested limitations in the empirical analysis, I was talking about the statistical analysis, not what I think is the major contribution of the paper, which is to do these hard calculations of estimating the size of interventions in credit policies by these countries. And I think it's a shame that we don't have more institutionalized these kinds of computations that would make such policies more easily compared to fiscal interventions in terms of their size, in terms of their impact on the economy. And I hope that what this paper will help do is to spur individual countries as well as international organizations like the IMF to do more of this. Thanks.
Thank you, Alan. The second discussant is Carmen Reinhardt.
So I definitely have to adjust this down from Alan. So actually, a lot of what I'm going to say, some of it there's a little bit of overlap with what Alan has already said, but it also, I think, there's a lot of complementarity. I'm going to do as a preamble of the discussion of the paper, just flag what we probably all know here, which was that the COVID shock, that the period they are looking at, was so exceptional in terms of the share of countries with annual declines in GDP. In 2020, 90%, about 90% of the countries recorded declines. And if you go back to 1900, that surpasses the 2 world wars and the Great Depression. So it's a great, great period. And given the cross-country impacts of COVID, you know, both Debbie in the remarks and the paper with Jihi certainly highlight, you know, that the stimulus came in terms of fiscal, monetary, and importantly, credit and what I will also call financial sector policies. I think this is, I hope this paper is going to be, you know, the first of a series of papers, because I'll get to that, but I do think that the broad use of credit support, in addition to the traditional, more traditional forms of stimulus via fiscal and monetary, is exceptional during this period. Now, one of the things I really liked about this paper is to estimate the impact of these policies. One has to begin to document them and quantify them. And this is, I think, where one of the things I really liked about this paper and the area of work in an also earlier paper that the 2 authors have done. And of course, my push is going to be to take it beyond the 7 advanced economies. I will bring in a lot of references from the World Development Report that the World Bank did in 2022, which was very focused on the credit policies and financial sector policies that were quite prevalent. And I would argue, you know, it's been discussed that maybe the emerging markets and developing countries did less. They certainly did less in fiscal. They did less in monetary. They did less in terms of credit policies, but they did not do less on forbearance. So if you were to look at the pie of the distribution, and if you would just call financial sector policies the combination of credit and forbearance, they did proportionately more on the financial sector policies. And in Debbie's remark, I had not picked this up in the paper, and I read the paper carefully, but she mentioned, look, Spain, Italy, and France may have done proportionately more than the US or the UK because they were facing other constraints. So obviously, they can't do independent monetary policy, and they had fiscal constraints. And that's very true, as hopefully I will show also in a couple of slides for EMs. And I kind of like to call what the authors do their augmented fiscal policy, which is, you know, you take traditional fiscal credit policies plus the forbearance. Now, I am going to have 3 quibbles with the paper. I think the authors are well attuned to everything I'm going to say. Understandably, given the depth of what they cover and the level of detail, their starting point, and I hope it's their starting point, is 7 advanced economies. I would argue that to do the second part of where they'd like to take this, which is to go from documenting the credit policies, quantifying the credit policies in addition over and beyond fiscal, and then looking at macro outcomes, they need to go further. And, you know, that's, I think, for a line for future work. What I will highlight is pretty much along the lines of what I've already said, that the policy stimulus mix really was quite diverse across countries in different income groups, and even within income groups, there was a lot of heterogeneity. And here, you know, what we see is pretty much, I think, what has been discussed already, that on the fiscal front, especially if you look at the red are the low-income countries. You know, very, very little by comparative standards was I'm sorry? Was done. I would note, however, that when we get to debt moratoria, there is one dimension that is worth mentioning for the low-income countries. The debt moratoria had, if you will, 2 layers. One is what was done domestically to support businesses and households, and one was what was done internationally. The debt service suspension initiative is very much a moratoria that meant low-income countries did not have to service the debts of their official creditors. So this is a big time. You have to go back to the Hoover moratorium in 1931 to see any kind of broad-based and the take from, you know, the 74 eligible countries. The take was more than half of those countries took up the DSSI. So when you go to all I'm saying is when you go to the realm of credit policies and debt moratoria and the stimulus that those policies provided during the pandemic, this chart doesn't tell you the whole picture because this is strictly the domestic dimension. There is an international dimension to this as well. So the second quibble, which in the presentation I know Debbie spent some time on, is I've been very concerned, notwithstanding that my priors are really aligned with the authors in terms of, I think these financial sector policies provided an important source of additional stimulus, but importantly, that they also brought on a lot of risks. And for the middle income, both middle high, middle low income, and low income, as I said, the forbearance, regulatory forbearance, because it was relatively costless, was used fairly intensively. And the concern is, of course, that we have a lot of non-performing loans, hidden non-performing loans at the moment that the new forbearance policies allowed institutions to not record this as indeed non-performing. And note that in regulatory forbearance, advanced economies. So I take the point that the authors don't highlight this because this was much less used by the advanced economies in the sample. But this was a big deal when you move into middle and low income countries. And that comes with much less transparency in interpreting financial institution balance sheets. And I'm not going to get into the details here, but we did do exercises comparing survey data on at the firm level, saying, do you expect to be in arrears in 6 months? Do you expect to be in arrears in 9 months? And you compare that, whoa. Now, this is, Alan had his issues and now I am having mine, okay. So now we're all set. But the point being, comparing non-performing loans as reported by the banks and the firms gave you a very different picture of late payments. And so the second quibble was, make a bit more also that while providing necessary stimulus at a time of severe downturn, the policies also do, to the extent that regulatory forbearance was an issue, also came with some risks. The third one, Alan already alluded to, which is where I think the paper is much, much in the beginning stages, if you will. The suggestive part is that linking the policies, the credit policies, to the macro outcomes will require a lot more work. One is maybe, providing a very basic starting, conceptual framework, because throwing in inflation in the bag with, I have strong priors of what credit policies and financial sector policies would do for GDP, or would do for saving, or would do for consumption, or investment, but I don't have priors of why it might necessarily impact inflation, certainly contemporaneously. So, basic framework, but, and I should say, after listening, it's not really 7 observations, it's 6 observations. I think we have to take with a grain of salt, as I said, even though my prior is that indeed these policies provided the scope for indeed acted countercyclically. I think, however, that even if we were to assume that all other shocks are identical during the period in which they're covering, and that the only differentiation was the scale of the financial sector policies, we know that other shocks during that period were different. Indeed, the evolution of COVID itself would have an impact on GDP, would have an impact on saving, and those things need to be controlled for. And also, of course, there were other policies that were complementing in the same direction, as the forbearance policies, as the credit policies. Some of the more monetary policy, more central bank policies worked in that direction as well. So teasing some of these out is important. And last, initial conditions vary enormously. So controlling for initial conditions, especially access to domestic credit, access to external borrowing, are important factors to control for when one moves from looking and quantifying the policies, which I think the paper does beautifully, to looking at their potential macro outcomes. And I'll conclude by saying that my call to the authors is that they, keep this valuable line of research. I do think credit policies are grossly understudied in this, that the COVID shock, as per my first slide, provides an exceptional cross-country, richness of experience to look at credit policies, but also not to forget that the credit policies at the international macro level were also of that ilk. They were also forbearance policies. We can't forget things like DSSI in this picture. Let me stop there.
Thank you, Carmen, and thanks to both discussants. We'll open it up for comments now. For those that are on Zoom, raise your hand, and then we'll promote you to panelist and then call on you from the floor. So let's start with Bob Hall.
Thank you. It seems to me it would be useful to bring in the economics of insurance, because they provide a way to quantify the benefits of a credit program. So the basic principle of insurance in this case is the stabilization of marginal utility, and that people will try to do that if they can, but the government can help a lot in a crisis situation, and in fact in the U.S. did succeed in stabilizing marginal utility, that is stabilizing consumption, and some parts of those programs had almost a pure insurance character. That is, the government didn't put up anything but net, because there was a repayment requirement, and yet the area under marginal utility, which would have been great, was pushed almost to zero by these policies. So that would provide a tool for a further quantification of the benefits of a pure credit program.
Thanks, Bob. Kristen Forbes.
Thank you. This is a very nice paper. I had a question and then a comment. So first the question, do you have any time series data on what share of fiscal policy is done through, let's say, traditional policy, the sort of on-budget policy, versus the, let's call it off-budget policy, credit guarantees, loan guarantees, et cetera? My guess would be that we're seeing more fiscal policy done through the sort of off-budget mechanisms over time, and that will only accelerate given high debt levels and fiscal constraints. If so, this paper will just become more and more important over time to get the accounting right and force countries to get the accounting right. If this is the trend, it will only accelerate. So that's the question. The comment is, you showed this interesting graph that showed the aggregate fiscal response when including both types of policy was roughly similar for your set of countries, but how it is divided is different. A theme picked up on by the discussants with Spain as an outlier. And you threw out this hypothesis that maybe it's because Spain and others are more fiscally constrained, and that's why they had to do more sort of off-budget guarantees. And there is some nice evidence that you could use to back that up. I think you're right. Alan was too modest to mention that he has this whole series of papers which shows the importance of fiscal space and debt levels for how much you can respond using traditional fiscal policy. And then also there's some more recent work, I'll be less modest than Alan, that I've done with Katerina sitting next to me, and we look at just the fiscal response to COVID. And we look at a whole set of policy responses to COVID. And we find that the fiscal response to COVID, when you use this broad IMF measure that includes all types of fiscal policy, that it didn't seem to be constrained by fiscal space. But when you look at how they did that fiscal response, it was more, you're more likely to do the credit guarantees, off-budget sort of support if you have higher debt levels. So it does support your hypothesis exactly.
Thanks. John Sablehouse.
Thanks. The first comment builds on Kristen's, which is there any narrative evidence about what was happening? What were the various legislative bodies talking about in 2020 in terms of responses that might help support that even further. And then the second comment is about the outcome measures that you care about. One of the reasons some of us believe we should be very aggressive in situations like this is to avoid, the damage to the economy that goes beyond creative destruction. Did businesses keep their doors open? How did that vary across the countries? And something broad like real GDP captures that downstream, but there might be other intermediate types of outputs that you could look at that would further support those ideas.
Great. I'm going to go to Zoom now. Shebnem, let's see if you are there. Excellent.
Yes.
Go ahead.
Okay, thank you so much. Great paper and discussion. This is a heroic effort because I also work on these things, and it is very, very hard to put these estimates together, as Debbie said. So I just want to mention, because this came up several times, emerging markets and international dimension in Carmen's discussion and also Ellen's. So we did a Jackson Hole paper in 2021 with Pierre-Olivier Gorincha, Veronica Sender, and Nick Penjovaca, exactly on this topic. We didn't do forbearance, but we did firm credit policies, programs like PPP for 18 advanced economies and 9 emerging markets. And we do find similar results to Debbie, but I would like to add that we also find, in terms of outcomes, these policies prevented SME failures. Small, medium enterprises failures in all these 18 advanced economies and 9 emerging markets, which is of course going to add to this net benefit, net cost calculation. So I'm wondering if the authors would like to look at things like that in the future, in addition to macro outcomes, because this is going to of course add back to macro inflation, employment. We also find, multipliers were small in terms of output, but employment effects were great. Exactly because SME bankruptcies were prevented. Thank you.
Thanks, Shebnem. Amy Finkelstein.
Thanks. My comment is very much on the lines of what Bob was talking about the potential insurance value of these policies. And in particular, I thought the graph you put up of the envelope size relative to take-up was really interesting. But there is sort of two, different ways to think about that. One is, there are frictions of, transaction cost information, et cetera, that prevented people who would have, or organization firms that would have benefited from the program taking it up, and that's, potentially unfortunate. The other is actually the entire envelope was providing much valued insurance value, and just as, I benefit from my insurance, even if I don't have a claim this year, people were benefiting from the insurance value. And I think, obviously, there can be some combination of both, but anything you can do to help in future work us think about how much of that we should be thinking as free benefits versus unfortunate frictions would be very helpful in trying to think about credit policy.
Great. Eric?
Yeah, I'm sort of interested in thinking about the policies that are targeted at firms specifically, and whether political economy considerations are worth paying more attention to. So two aspects of that. One is just relative to traditional fiscal policy. These types of policies kind of directly often benefit friends of policymakers or policymakers themselves, maybe more than traditional fiscal policy. And so political risk or risk of capture with these kinds of credit programs can be quite important in the SME or even larger business area, even relative to some of the other bread and butter plain vanilla programs. And then the second component is like whether political economy considerations can help us understand the cross-country evidence, the relative importance of like banks versus non-banks in the financing of economic activity, and how they like involved in the political debate, maybe going back to John's point.
Jason Furman.
So I was interested in how you think about where you draw the line with sort of second, third, fourth round effects. You take into account if you lend someone money, what does that do to the probability they get repaid? But how about more dynamic considerations? You do a $10 billion bailout here that costs $10 billion in fair value, but people don't lose their jobs and start collecting public programs like Medicaid, and so you save on that. Or you do a $20 billion thing here and GDP goes up and you collect more in tax revenue as a result of that. Is there sort of some conceptual line you can draw between the type of dynamic analysis you do to do the credit scoring and the sort of full-on macro interactive revenue, et cetera, feedback.
Joe Bulio.
Thank you. So, kind of following up on some of the comments on the insurance stuff, are there substantial differences between some of the fiscal programs and credit programs in terms of efficiencies and some of the things the incentive things that economists generally talk about? So, for instance, obviously, like with taxes, there are Oaken law gaps, like gaps and things like that, whether or not, those things if there's some variation across countries in the way they design these programs on that score.
That's all the questions I have. I'll just add one more into the mix before you jump to your mic, Debbie, which is the forbearance that you measure in the U.S. In the Cherry et al. Brookings paper from 2021 that you cite, one of the remarkable things in the housing forbearance was how quickly it was paid back. So by the time they wrote their paper, 90% of the people who had mortgage forbearance were repaying their mortgages again. So is that part of the reason that it looks so small? Okay, thank you.
Thanks to everyone for their questions and comments, particularly the discussants. So I'm going to say some things that are specific answers and some that were general issues that arose. So I think a lot of you are asking us to do more, and I'm going to turn around and ask governments to do more, because it isn't our job to be sorting through these obscure reports and trying to tease out numbers. So, I mean, we probably will do more, but with reluctance, because, there's no way this is going to be systematized. Economists, like everyone else, are kind of lazy, and we use the data that is presented to us. So, for some of the questions like, how does this compare historically? I mean, of course, we would have answered that question if someone had given us the data, but no one gave us the data, so we didn't even attempt to answer that question. And now, I know this sounds very defensive, but the reason we're dealing with 6 or 7 data points isn't because we hate econometrics. It's because that's what we could kind of scrounge up. So I just want to say I'm very sympathetic with everyone's reservations about drawing inference. I think that was more like proof of concept. Like if we had seen no relationship to macro, we could have dismissed it as only 6 data points. But the fact that we found at least some sign of life was kind of, at least I thought it was a bit encouraging, but we weren't trying to read too much in it. But anyway, just to, Alan asked a lot of questions that were very pertinent to my, a lot of my previous work on the budget stuff. I just want to say that a lot of what you were saying, Alan, seems to me like it was really an endorsement of accrual accounting in the budget, because it wasn't like you were saying it was wrong to be forward-looking on the credit side. You were saying it was wrong to not be forward-looking on the tax side. But there's a principle that in the U.S. budget went into the Federal Credit Reform Act, and it doesn't just apply to credit, it actually also applies to capital leases. But the line that was being drawn was between completely firm legal commitments and things that could be ex post change. And I know you know this, but I want the audience to know. So, in general, it's very hard to put accruals into a cash budget. And it's that tension that has made it so hard for governments to budget for credit in a reasonable way. But I also want to say that for most, just so people aren't confused, I know Alan does know this, for most tax policies, for most policies, we can say most policies have a long life, but the distinction is that a future Congress can change the rules. And so the rules of budgeting is that you project out over some horizon, but you don't treat those future things as absolutely firm because they're not. So the way credit is budgeted for is to simply capitalize the commitments made in a given year. And that's designed to make it comparable to the rest of fiscal policy on a cash basis in that year. Meaning, I could give someone $100 this year or this cohort of student loans could get a subsidy of 100 capitalized over the life of this cohort of student loans. But it's meant to be as parallel as possible. So I think there's a huge question about the pros and cons of going to accrual. I used to be all gung-ho on accrual, but then my budget friends tell me there's no discipline there. So it's complicated. But I just want to kind of clarify that, and I just can't resist doing this. So you could argue that, you know, my pleas for fair value are kind of a footnote on the whole thing, but I just want to point out they would be if the way the government in the U.S. accounts for them gave you a positive budget score that was just downward biased. But the political economy of the thing is that when something looks like it makes money, then it's like a double, oh my gosh, are we lucky? We made these student loans and we made money on them. And so the fact that they have negative subsidy scores is actually a problem in the US budget. I would almost say that in some of these countries that account for them completely off budget, they might actually be looking more carefully than the US that kind of has this knee-jerk, very small subsidies. So, I know Jason would probably disagree with me. Okay, I'm gonna leave the budget. I'll leave the budget aside. Yeah. Okay. Carmen, we are so sympathetic to what you said. I now have appreciated more that a big class of things we haven't, if we go to look at developing countries, we definitely have to look at that external support from various kinds of international relief. That's really interesting, and I think something I'd very much like to look at. Agree that forbearance was really a big deal. I think a distinction that Alan really emphasized to us in private conversation was the difference between forbearance that the government is paying for and forbearance which is just telling your banks what to do. It may be much easier in developing countries to do that. That's very much part of your general theme, which we completely agree with, that these things carry a lot of risks, a lot of lack of discipline, and you have to worry about that. So a big theme, Bob Hall and others mentioned insurance value. I think we agree with the general sense in the profession that COVID was a special instance where maybe insurance was more important both for fiscal policies and for credit policies than actually trying to stimulate demand per se. So I'm not sure I want to make a big distinction between the insurance benefits of the credit policies and of the fiscal policies, because in both cases there were resources being provided for people who otherwise couldn't afford to make essential payments or keep their workers. Several people, so the answer is we don't have time series data, Kristen. We wish we did. I mean, I've been watching these things for a while. I wish I had known about your paper, so I apologize. And I apologize to several of you, also the Jackson Hole paper. I'm sure we should have cited it. We didn't. I'm a bad scholar. Sorry. So we should have known, and I'm very interested in the whole fiscal space calculation, so we'll talk. Okay, but then in terms of what could be known about outcomes, I'm actually much more pessimistic because I actually heard two things in the questions which are almost on two sides of things, which is, you know, did it make things a lot better because it prevented defaults? Well, I mean, there's one argument that default rates were artificially lowered, and really what you had was the creation of essentially, at least temporarily, zombie firms. So in fact, now if you look at the statistics that are like coming out of Europe, you're seeing this huge jump up in default rates. And I mean, I tried to emphasize that a lot of these loan guarantees were for a number of years, so you weren't really going to see the problems for a while. So I think it would have been hard to go back and say, did it make things better at the time? It was tricky. On the political economy, I know in the US, I know you've worked on it, the PPP program was particularly egregious. It was kind of nice to study Europe, because gee, he could probably add a lot of color to this, but there was, you know, a kind of a more rational framework. So there was this kind of pan-EU framework which talked about what the guarantee fee should be and what the structure should be. So it had the sense of a less political, I mean, everything is political, but it seemed cleaner. The US was particularly bad. Luckily, they didn't do too much of it this time around. Sorry, I hope I haven't missed too much of what, Jihi, did you want to add anything?
Sure. Yeah, just to cover, I think just very small things to add to what Debbie had to say. On Europe, actually, they had this a temporary framework by the European Commission. Is it better? Yeah, thank you. So they had a more structure, but also when we talk to the authorities, for instance, UK Office of Budget Responsibility, they said they also looked at what their peers were doing in the continental Europe. So you see that there are some design similarities across countries across European countries, which was quite interesting. I think I completely agree with the more work that needs to be done covering more countries and just in broad the focus on credit policies. But just taking a step back, I really like how Carmen has mentioned this term policy stimulus mix during COVID. And we didn't even get to the point of if these policies were desirable or effective, because we don't know, we see these mix, the division that differs across countries, but were they the right policies? If we have another shock like COVID that hits us, is that what we recommend countries to do? And were they more effective? So we didn't even get to that point. So we're just really at the beginning point to put that into the narrative to discuss that. I'll just stop there.
Great. Thanks for that discussion and terrific presentations. We'll take our break, come back at 10 o'clock.
My solution is don't use this microphone. It's just to make everybody put this on.
Thank you. I kind of thought so, but I wasn't sure, so I wanted to make sure. Like, I thought it was really important, but I was very doubtful.
This is such a major step to take it to the point of this quantification, because it's also, as James was saying, like, we're so lucky to be able to do this in Brookings, because of course we never get that push in the AER because everybody's whining.
If everyone could start taking their seats, we'll start the next paper. All right, we'll get started. The next paper is the global economy deglobalizing, and with Penny Goldberg and Tristan Reed, and Penny will do the presentation.
Thank you very much, Jan, and thank you for the opportunity to present this paper. Let me start by giving you a roadmap of the slides and also the paper. Given time constraints, I won't have time to go through the slides in great detail, but I can give you a sense of what's there and that you can study them at your leisure. In the paper, we try to accomplish 3 tasks. The first one is to answer the question, is the world economy deglobalizing? And we approach this question through a mix of quantitative and qualitative evidence, using in 2 ways. So the first way is to focus on data, on focusing on some economic variables. And there we think there is a very clear answer to the question. It may seem like a very broad, open-ended question, but we think that the data permit an unambiguous answer. And the answer is there is no evidence of a reversal of trend. There is definitely a slowdown. The second way is to look at policy and public sentiment. That's where the qualitative analysis comes into play. And there our answer is that there have been dramatic changes in the last 5 years, and these changes are significant enough to justify the view that we are at the beginning of a new era. So that second part may be more controversial. We think that the first answer, namely that we are not deglobalizing yet in terms of data, is less controversial. Then we explore the causes of this anti-globalization movement, and we identify 4 main causes. The first is that the perception that competition with low-wage countries, and especially with China, has become unfair. Second, the increase of within countries inequality, and specifically one particular dimension of inequality, geographic inequality. Third, concerns about the resilience of global supply chains that became very salient during the COVID-19 pandemic. And finally, geopolitical concerns that again were highlighted through the invasion of Ukraine. And finally, we talk a little bit about consequences at the end, both short and long-term consequences. And obviously, these are very speculative at this point, given that this is all unfolding, all these developments are unfolding right now. But I will quote Jim's introduction, that sometimes it's useful to make assessments when something is going on rather than waiting and looking at this from a historical perspective. I'm sure, when it comes to history, our discussant, Doug Irwin, will have a lot to say. So let me start with the data that I talked about. Is the economy deglobalizing? This is actually a pretty old question. So people have been debating this question for the last 5 to 6 years. And the reason for this is this figure. So what you see in this figure is how trade has developed over the last few decades. And the darker line at the bottom shows the total value of trade in goods and services, world trade, world imports, starting in 1989. 1989 is by many viewed as the onset of the hyperglobalization wave. The top line, the dotted line, shows trade as percentage of world GDP. And what you can see, this is a figure that's well known among trade economists, but for those of you who are not well versed in the topic, you see the very fast growth of trade during the period of hyperglobalization. So not only is trade growing very fast, but it's also growing very fast as percentage of GDP. So it's growing faster than world GDP. Then comes the financial crisis, the global financial crisis, 2009, and then you see a very sharp decline in world trade. Afterwards, trade bounces back for 1 year, but then it slows down. And so this slowdown that you observe, the slowdown is evident if you look at the relative trade, so trade as percentage of GDP. In absolute value, trade is still going up. But the slowdown you see in the top line, this is what gave concerns that we had entered a period of deglobalization. If you look at this figure, though, you don't see, again, a reversal in trend. What you see is a slowdown. And this is why people have also used the term slowbalization rather than deglobalization. And there is a large literature exploring why this has happened. I have contributed to this literature. Our discussants have. The World Development Report of the World Bank explores this slowdown as well. But this is what started this entire literature a few years ago. You can actually do much more in terms of data, and we do a little bit of this in the paper. Given time constraints, I don't have much time to go through these graphs, but let me just advertise them. In panel A, we look at the same variables, but by different countries or country groups. And the one big takeaway from this figure is that this slowdown that I talked about before is very much driven by two large countries, China and India. Yesterday we talked about these dual circulation policies that China has been pursuing, meaning that China has been emphasizing domestic demand, while not necessarily retreating from exports, but domestic demand had become the priority in the previous decades. And India had also, as we talked about again yesterday, has turned out much more nationalistic in its policies. In panel B, we look at intermediate goods services, and the reason for that is this is often viewed as a good proxy for trade that takes place in global value chains, which have become increasingly important. In panel C, we look at capital flows. In panel D, we look at inward migration. The focus in this paper is primarily on trade. It's entirely on trade, actually, and the reason for that is this is where the policy action is right now. But of course, needless to say that one could write different papers focusing on migration or capital flows. These are very interesting developments as well. That said, if you look at any of these graphs, in some cases you actually still see growth, especially for particular countries. You definitely don't see a reversal in trend. And in some cases, you do see a slowdown. That's why I said at the beginning, even though this seems a vast question, very open-ended, ultimately the answer is pretty clear to us. There is definitely a slowdown. Trade is not growing as fast as during the period of hyperglobalization, but there is no reversal evident yet in the data. What about policy and public sentiment? There we think it's a completely different story. What we've seen in the last few years, probably most importantly since 2016, we've seen a reversal of decades-old liberalization policies in two countries, the UK and the US, who had been the bastions of international trade, of free international trade. So some of these events and developments are well known to everyone. The Brexit vote in 2016, the US-China tariff war, the paralysis of the World Trade Organization since 2019. This is, of course, a crisis that had been brewing for a while. More recently, we have various provisions in the CHIPS Act and in the IRA, and again, we talked about all this yesterday, that have been characterized as a new industrial policy that we may have different opinions about whether these are good policies or not, but as many have pointed out, they are a departure from the spirit of multilateralism that had been celebrated before. And finally, most importantly, we've had in the last year the export restrictions targeting the semiconductor sector in China. These are sweeping export restrictions that have been characterized by the Financial Times as an open declaration of economic war by one superpower, the United States, to another superpower, China. So this is not just a minor trade policy change. This is really, again, to put in the words of the Financial Times, this is economic war, and this is a significant change. At the same time, we see in other regions of the world new trade agreements, regional trade agreements being formed. So again, one might take the view this is only specific to the US and the UK, but the US and the UK matter both by virtue of their economic size, but also by virtue that these have been the big advocates of free trade. What about public sentiment? Again, we see big changes there. As late as 2018, 2019, people were still very much in favor of free trade, and there is a big project going on under the supervision of Angus Deaton, the Deaton Review that explores the sources of inequalities in advanced countries. And there, among other things, we review attitudes towards global issues, towards global trade. What's documented there is that in most countries, with the exception of Italy, actually, most people are still very much in favor of free trade. However, by 2022, we see a completely new vocabulary emerging, concerns about resilience, geopolitics, reshoring, friendshoring, national security. So what are the causes of all these developments? So this is a table that pretty much summarizes what we say in the paper. So we chart three phases in this deglobalization movement. Phase one, between 2016 and 2002, is characterized by concerns about this unfair competition with China and the labor market disruptions that trade with low-wage countries has caused in advanced economies. There's a lot of work in international economics that shows that some of the concerns in labor markets, such as the increase in the skill premium or polarization, cannot be linked to trade. However, recent research has emphasized the emergence of a new form of inequality, spatial inequality, regional inequality. And there you can very much link this increase of inequality to what has happened with imports, with import penetration. The consequences of all this is, in the UK, Brexit, and then in the US, we had the tariffs. However, trade proved robust to all this. Phase two is between 2020 and 2022. This is the COVID period. And there we have all these concerns about supply chain resilience. Our point in the paper is that despite these concerns and the attention they received in the press, there was actually no evidence supporting any of the claims that were made. And as a result, we didn't see any ramifications in policy. We didn't see any policy action in response to these concerns, and trade once again proved very robust. So all this would have seemed to be just a passing phase until we had the invasion of Ukraine in 2022, and that we view as a game changer. I'm sure economic historians will debate in the future whether the true concern has been, or the true catalyst was Ukraine or not. But I think the one thing that I'm comfortable saying is that it was the invasion of Ukraine that actually made the concerns about national security salient for the first time in recent years. And as a result, we have major policy action. In Europe, we have decoupling from Russia. In the US, we are in the process of decoupling from China. And these are, again, developments that would have been thought completely inconceivable a few years ago. Getting more into the specifics, I'm not going to talk more about the phase one, partly because it has been explored in great detail. So I have a monograph coming out that looks more at this issue of unequal effects of globalization and how there is increasingly a perception in advanced countries that many of the things we have celebrated in previous decades, the decrease in global poverty, the decrease in global inequality, have come at the expense of advanced economies. As I said before, the consequences were Brexit and Trump tariffs. Brexit has had probably more severe consequences than the trade tariffs, and this is partly because Brexit is a major policy change for the UK. However, one piece of evidence we bring to the paper is that recent empirical work has shown that the trade war between US and China did not reduce global trade. It reduced trade between the US and China, as you would expect. But actually, other countries picked up the slack, and actually, global trade increased as a result of these tariffs. This is what's shown in this graph, but I will skip it. Phase two is the phase associated with COVID. And there we hear this argument repeatedly that a chain is as strong as the weakest link. This is not entirely a new argument. It was made very much in the context of the great earthquake in Japan in 2011, but it gains new significance during this period. And as we show in the paper, the actual evidence is at odds with this argument. So let me briefly go through our thinking. We start with asking the basic question, what is resilience? And a very useful starting point is the book by Marcus Brunemeyer, The Resilient Society, where he contrasts the reed as an example of resilience to the oak as an example of robustness, making the point that we think of resilience as being a case where the object of interest bends but doesn't break. This is, I think, a very useful way of thinking about this issue, but it still raises the question, how do we operationalize it for economics, and what's the proper benchmark? And in this entire debate on resilience, we have lacked a clear benchmark of resilience. There are many conceptual issues that one can raise, and this schematic gives you a sense of the various conceptual issues that one can face. The main point we make in the paper is that we cannot talk about resilience without reference to the specific shock we are thinking about. And the things that matter here are the nature and the magnitude of the shock. Are we talking about supply, demand, or both? Is the shock sector-specific or country-specific or both? Is it idiosyncratic or systematic? Why do these things matter? Just to give you one example, if you have a demand shock, let's say a drop in demand due to health concerns or to drop or to unemployment or drop of income, then whether you are diversified or whether your inputs are diversified or not is going to matter very little for the resilience of the economy. If you have a shock that's specific to one particular country, then you actually want to be diversified. You don't want to be importing just from this country. However, if you have a shock that's really systemic, that's a shock that's really global, then diversification is not going to help very much. And perhaps most importantly, if you have a shock that originates in your domestic economy and you are not diversified, then you are actually going to be hit much harder compared to the case where you are internationally diversified. So the nature of the shock matters very much. The time horizon also matters. In the case of face masks, we were talking about getting these face masks within the period of a week or a month. Whether US consumers have to wait for 2 months to get a new car or not, is that an important question or not? This is something that we can debate. And finally, it depends on the level of aggregation. When we talk about resilience, do we talk about specific firms, industries, or the economy as a whole? And when it comes to COVID-19, know that it was both a supply and demand shock. It was global, though not completely synchronized, and arguably the largest shock, global shock since World War II. And judged by this bend but not break criterion, the world economy proved incredibly resilient, and there are, of course, good reasons for that. There's also very, very strong fiscal and monetary support, but we make the point in the paper that actually trade played a very important role. And the argument, very briefly, can be summarized as follows. You can look at what happened to trade in the aggregate. Trade volumes declined very sharply through 2020, but they rebounded in 2021. In the paper, using the Panjiva data, we look at firm-to-firm relationships, exporter-importer relationships, and we show that these were actually not disrupted during this period. The import volumes declined, so the intensive margin responded, but not the extensive margin. And this is important because relationships take a long time to build. So again, by this criterion, imports were bent but not broken. And finally, so this is this graph in the paper, and finally, imports actually alleviated bottlenecks, despite what was said in the press, and let me just show you this graph that tells the whole story. This shows what happened to imports of face masks. The big spike you see, it's in March 2020, when there was huge demand for face masks, and the imports that alleviated the domestic demand bottleneck actually came from China. So there is additional evidence that comes from various studies that have used modeling approaches, counterfactual simulations, to assess the effects or to assess the resilience of the economy during that time. And the general conclusion is that it didn't have any major effects on the economy, and in fact, it proved incredibly resilient. What did, however, change is the attitudes keep changing. So this is a period, again, where trade is portrayed as being a source of evil, as imports from other countries are portrayed as being the source of the problem rather than the solution. Then we enter phase 3. As we said before, the catalyst is the invasion of Ukraine that exposed the fragility of supply chains to various kinds of risk, namely geopolitical risk. And that way, it is not necessarily that Russia is so important in world trade. Russia is very important to Europe because of Europe's dependence in energy on Russia, but it was not important for the world market. But by analogy, many policymakers in the US thought what is going to happen if we face similar issues with China, where the dependency on China seems much higher. So national security became the primary concern. And again, another term emerged in the everyday vocabulary, dual goods, so goods that have both civilian and military use. So that leads to another important consideration: how diversified is international trade? How diversified is US trade in particular? We provide some evidence in the paper. This is this table. And just to give you the answer, trade is actually, in general, very diversified, but it's not diversified in some critical goods. In some critical goods, in the health sector and also in other goods that can be considered strategic, it's highly concentrated. That said, the origins are not only countries like China. In fact, in most cases, the origins of these imports are friendly countries like Mexico or Ireland. But there is one case where there is very high dependence on China, and this is the case of face masks. So this is the top line on the left panel. In face masks, we have about an 80% import share from China. So yes, there is also high dependence in some other sectors: electric car batteries, semiconductors, and crude oil. So there we show the dependency from what is considered non-friendly countries. So does this justify this retreat from trade with non-friendly countries? In principle, there is a valid argument for diversification, we think. However, some of the concerns, so I will wrap up shortly, note that the imports from China, and China had an 80% market share in masks, were helpful during COVID-19. So decoupling from China may increase resilience to geopolitical risk, but not resilience to other types of shocks or health shocks. Some of the import sources, as I mentioned, are non-friendly countries. And there are also other issues. For example, friendliness is not constant over time. Friendliness in our data is classified, is determined based on survey responses that are conducted, surveys conducted by the government. And one thing that's really striking is countries like Indonesia, Vietnam, and Malaysia are labeled as non-friendly. You can easily figure out why. The past is probably fresh in people's memory, but this can show how quickly things can change. And finally, the use of goods, and are they dual, are they civilian or military used, and national security is something that we cannot verify. And in general, as economists and social scientists, we are trained to judge policies based on welfare and efficiency and inequality effects. And of course, there are always caveats, and we make often assessments based on assumptions, and we debate the assumptions and the models. But we know how to do this. When it comes to issues such as national security or dual goods, we don't have a good way we don't have benchmarks, we don't know how to measure these things, and ultimately we have to rely and put trust in the government, and even in a country that's democratic and transparent, as like the United States, this is something I think that should give us pause. And so let me just very briefly, that's my last slide, let me say a few things about the long-term consequences, speculative, as I pointed out before. Let me start, actually from the bottom. Many of these, the decoupling from China and many of the policies that are pursued these days are justified in the name of resilience. They may increase resilience to geopolitical risk, but it's not clear that they would increase resilience to other types of shock, and even geopolitics are shifting all the time. There is a real risk of military conflict. The pre-belligerence period, so the period between World War I and World War II, is very, very informative here, and this is something perhaps that we should study. When it comes to economics, I would argue that wars, either hot or cold, they don't necessarily contribute to prosperity. We can have concerns about the future of innovation and the future of long-term growth, and let me just finish with one point that I'm sure my co-author Tristan, who is in the World Bank, would like to make. Ultimately, there is also concern about how this will all affect low-income countries and countries where poverty is still a concern. All this emphasis on friendshoring will end up being, to a large extent, it will lead to trade between similar countries, between the US and European countries. The emphasis on labor and environmental standards, they may be well justified, but one of the consequences will be to exclude low-income countries from world trade, and these are precisely the countries that need trade very badly. So in the end, all these may have very important consequences about the future of global poverty. And thank you very much.
Thank you, Penny. The first discussant is Paul Antras.
Thank you very much to the organizers for having me. It's a pleasure to be back here at Brookings. It's been a few years, so it's really great to be back. And it's really great to be asked to discuss this paper. It's a fun paper to read. It's a very thought-provoking paper, and I look forward to the discussion more broadly. So let me begin by just very quickly, I know time is scarce, to summarize the main 3 points the way I see it of the paper. First, the authors make a convincing case that the world economy does not appear to be deglobalizing at this point in time. They also show that global trade was remarkably, resilient in the face of COVID, which was obviously a drastic challenge to the functioning of the world economy. And finally, the authors identify a recent change in the policy environment, which they tie to particularly closely to Russia's invasion of Ukraine, that foretells perhaps a highly uncertain future for globalization. So let me quickly illustrate the first point. I think that's uncontroversial. I'm basically plotting the same series that Penny was showing. On the left-hand side is world trade over world GDP. If you really, really wanted, you maybe could see like the beginnings of a decline in the last few years. But as Penny pointed out, it's really driven by a handful of countries, China most notably. And this has nothing to do with the trade war. This precedes the trade war. This is basically China growing, developing, gaining capabilities in sectors away from pure assembly, that's moving up the chain. And whether you want to call that a deglobalizing force is not entirely clear. So that's the facts. One way to put it, I'm paraphrasing Solo here, which is that you can see the deglobalization age everywhere, but in international trade statistics. There's lots of talks, but there's not much data at this point. So it hasn't happened, but obviously, perhaps more interesting question is, will it happen? Might it happen? Are the authors right in pointing out that we might be entering a different phase? Before I tell you my take, I'm tempted to put up a couple of quotes. One is one that I guess central bank analysts often like to remind their bosses, that it's predicting the future is not as easy as predicting the past. And then there's this other quote which I quite like. I don't mean that as a sort of sneer on the authors, but we need to be a bit mindful of that. Sometimes it's a bit hard to do this job. So in that sense, my view actually agree very much with what Penny was talking about and what's in the paper. But I'm not going to repeat the same, set of arguments with a different Southern European accent. I thought what I would do is to outline 5 aspects where, in my views might depart a bit from what you've just heard. So the first one is on resiliency, and I think that's indeed, I completely agree that the world economy has been resilient, and I completely agree that there's something that ties firms together that lets them ride these shocks, and I'll say a bit more about that. But I think it's important to point out that resiliency is costly and to outline those costs. I'm going to talk about interest rates, something that wasn't brought up during the discussion, but some recent work of mine is leading me to pay particularly attention to interest rates. I'm going to say something about Russia and China very quickly because I think my views are closer to theirs, and it's particularly given what we just heard Penny say. And then if there's time, I'll quickly talk about deglobalization in other markets. We could talk a lot about capital markets, but I will say something about labor markets, where I think that's something to keep an eye on. And then finally, if there's times, I'll just sort of make a plea for a more multidisciplinary approach to these questions. Okay, so first, resilience is costly. I believe that there's one feature of global value chains that is central, which is that in the formation of these global value chains in the hyper-globalization period, firms incurred very, very significant upfront costs, which are very often sunk in nature. Okay, you go abroad, you set up plants, buy a bunch of specialized machinery. You're in China. If you want to move out of China, that's very costly because you're not going to recoup that investment. I think that's very important for understanding hystereses and resiliencies in the face of a dramatic shock that was perceived to be a temporary shock. Now, obviously, when we face geopolitical shocks that might be more persistent, that might lead to a relocation of production. But arguing that the COVID shock has shown that firms were following wrong strategies, that they were under-diversified, I think that's a big leap. There's a good reason why firms were not diversified. First, in terms of data, it's easy to see that. If you look at U.S. import data from customs data, you observe that the vast majority, the overwhelming majority of U.S. firms were not buying the same input from more than one source. You could take the view that they were not doing a right assessment of the risks involved in that. My sense is that they were doing that because it's very costly to diversify. They would have had to incur this sunk cost multiple times if that's something that they probably thought about but discarded. Which means that if for geopolitical reasons there's a push towards diversification, that will necessarily come at some cost. That we should not expect firms to be able to operate with a diversified supply pool as efficiently as they did without it. Let me turn to interest rates. So that's a fact that at least us trade economists, I think we tend to ignore, which is the same period of hyper-globalization of the late 80s, 90s, and early 2000s came together with a very significant decline in real interest rates. I don't think these are just correlated events, that they have nothing to do with each other. As I just argued, the formation of global value chains entailed very significant setup costs. And I think the fact that interest rates were getting lower and lower facilitated that expansion. At the same time, because many of these costs, as I've just argued, are sunk in nature, if we are to witness a deglobalization or reorganization of the global economy where firms are going to be moving out of China onto other friendlier and closer countries, well, that's going to involve a lot of investments. And if we may be entering a phase of higher real interest rates, we should not expect this process to be as smooth as the expansion was. So that's just a thought, and it's sort of, I've been thinking in recent work on exactly how to think about this mapping between global value chain expansion and interest rates. The third point I want to quickly, time's is scarce, but let me quickly touch upon the issue of Russia versus China. My sense when reading the first version of the paper, there was a lot of emphasis on Russia. And, you know, from a trade perspective, I'm really not too convinced that if Russia were to decouple persistently, that this would be a very significant impact on the world economy. If you just look at the importance of Russia in many sectors, there's very few sectors in which they capture a relatively large market share. Perhaps in Europe, there was more fear of an impact, but I think it's fair to say that even Europe, and even for energy, they've been able to find ways to cope with that. So at the same level, I'm not entirely convinced that this Russia's invasion of Ukraine is going to be a key phenomenon, in the sense that even absent that invasion, I think geopolitical tensions would have probably been on the rise. It's very hard to kind of figure out whether that's true or not, but you know, the use of friendshoring very much precedes the invasion, and I think there was an increasing sense that the relationship with China was becoming worse and worse. And I'm indeed increasingly concerned about China. The same figure is telling you that a decoupling of China would be problematic. They control a high market share in many sectors. Penny was telling us similar facts. I'm perhaps a slightly different point I'll make is that a common view is that we should not be concerned about this because China is a pragmatic economy and they realize that decoupling would be very costly for them. Semiconductors is a typical example where people say, this is not going to happen because they're going to need some machines from Europe. They need the US technology, so don't worry, things are going to settle. I'm a little bit more worried because I think we often take for granted, and folks that have looked at the quantitative implications of Chinese decoupling, they often take for granted that it would be China that would go on their own. But if I look at the structure of world trade, and that's sort of there's a lot in this figure, but it's basically showing you countries connected to their primary trade partner. You know, it's pretty clear from this figure, I think, that just taking that big red dot and removing it from the World Trade System might not be the way to think about this. I've been traveling recently. I was in in Chile. I was in the Middle East. You talk to a lot of countries, and their ties with China are enormously important. And if they are faced with a choice at some point about are we going to go along with our natural allies or historical allies like the US, or are we, and therefore give up our links with China? I think we often underestimate just how a non-trivial choice many of these countries are. So if you look at the countries around China there's many of them that we would typically think as natural allies of the US, like Korea or Chile and so on and so forth. So again, a potential decoupling of China is not just China. I think the US might actually lose access to a very significant share of countries. Very quickly, a couple of more sort of loose points, but I think important. Deglobalization in labor markets, completely agree. If you look at series of migration, they're not down in recent years. I think refugees had a lot to do with that. So, I mean, it is not something to be particularly cheerful about. There's been a lot of movement driven by refugees moving. At the same time, and I'm sure we're going to hear much more from Doug on this, but if you look at historical episodes of deglobalization, true deglobalization, like the interwar period, those came with very dramatic declines in mobility of labor. Okay, and we are seeing more and more policy actions, policy messages that seem to be restricted towards immigration. And as a trade economist, I might be worried about this, and I might lose sleep over scenarios in which the world is going to be much less globalized in goods markets. But to be honest with you, I believe that the real income implications of deglobalization in labor markets would be severely higher. Okay, so this is something that I understand why that's not the focus in this paper, but I hope people are paying attention to. In the last 40 seconds, let me just raise my last point, which is this needed of a multidisciplinary approach. A lot of what Penny said, a lot of what I said is something that could be shown a bit more formally by developing general equilibrium models of the world economy and studying different counterfactuals where China decouples, Russia stopped selling oil to Europe and things like that. And there's been a bunch of recent papers that have nicely illustrated these implications. I'm not showing you this, and probably Penny was not showing you that, because many folks in my field have some qualms about this quantitative revolution in our field. And it's not because we don't think that quantitative work is important, but just the way it's done has some problems. In my view, the way that this is typically done is less estimation in a sort of an econometric sense, but these are models that are basically forced to fit the data exactly. You're basically calibrating hundreds or thousands of parameters to fit the data exactly, which is fine, but if you're going to use this for prediction, obviously overfitting is a big problem. So I do think that my field, which has embraced macro, and I think that's probably a good thing, but maybe it should be looking at other fields as well, where we understand that models may not fit the data exactly, but there is a reason. There is a reason for that. And the last point is about, it's not just about economics, but if the goal here is to put a probability distribution over different outcomes, China decoupling, we're good at saying, perhaps we're good at saying, if this happens, this is what's going to happen to the world economy, but we're not equipped to figure out exactly how likely a Chinese decoupling is. So we maybe need to kind of be a bit more modest, or sort of be more open to kind of talk to folks in fields that might be following politics a bit more closely, and also in our own modeling, just embrace some of the ways in which they think about governments operating in the world economy. That might help us also in our predictive power. And I'll stop here. Thank you.
Well, thank you very much. The second discussant is Doug Irwin.
Well, a quarter a century ago, in this very room, I presented a paper with Michael Bordo and Barry Eichengreen comparing the globalization that was emerging in the mid-1990s to that a century earlier, the first era of globalization from the late 19th century to the late 20th century. What did we conclude? I don't know. It was a long time ago. Haven't read the paper. But I think we concluded that at that time, in the mid-1990s, it looked like the level of globalization was exceeding that in the late 19th century, early 20th century, but it was a closer call than you might have thought. But what we saw after that is another decade of intensification of globalization, and we're in a new era. Who would have thought 25 years ago that we'd be discussing a paper on deglobalization? I certainly didn't, but of course this is the topic of the past few years. Now, if you just look at corporate talk about deglobalization in their calls, what you can see is not much for the last 15 years. Last 2 or 3 years, it's really spiked. What I find interesting about this is there's no Trump effect. So Peter Navarro said we're going to rip up all the supply chains and bring them home. No one took them literally or seriously, apparently, companies, but they did take COVID very seriously. You can see that's the first spike. And they have taken, apparently, the Biden administration very seriously. That's the second spike there. But this, of course, is in the headlines. Very topical paper. Really enjoyed reading it, and I do commend it to you. It was a great presentation. It was a very tough assignment, what they had to do, because there's a lot of moving targets. We're sort of midstream in a lot of this. So my hat is off to them for analyzing things. The paper is particularly good on resilience, and of course that's a major goal of policy and what have you. The paper also has a lot of wise insights, so I think it is very much worth considering. Now, of course, globalization, it's a multifaceted phenomena. It includes trade in goods and services, capital flows across countries, labor mobility, technology and data flows. Now, in the paper with Barry and Mike, we tried to look at all of these in a very quick way. This paper just focuses on trade, and I think Penny identified a really good reason why. That's sort of where the policy action is. And that's where we have some good information. So this is their first picture, and I would focus on the light dashed line, dotted line, which is trade in goods and services as a percent of GDP. We trade economists look at this a lot, and you can see since '89 it soars quite a bit, then it's sort of flat, maybe down a little bit. Paul also looked at that, pulled back a little bit to 1970. But of course, what I want to do is put things in historical perspective. So I'm not going back to 1970, I'm going back to 1870 to see whether that flatlining is a historical anomaly, whether it's a historical regularity, whether we've seen it before, and what are the potential drivers of that. So when we go back to 1870, this is what it looks like, and you can really see how the post-World War II era is really quite different. But you can really tell the history of the world through this chart. So there are really 5 eras of globalization, and I think it's very clear that we are in a new era. So the first era, you can see there on the left, late 19th century, early 20th century, up to World War I. Think steamships, think refrigeration, think the telegraph, a lot of labor mobility across countries as well, slow but rising global integration. Now, one reason I think we're concerned about the recent trends in globalization, that downturn in period 5, is that first period of globalization didn't end so well. So it came to a rather abrupt stop in the summer of 1914. And there are a lot of eerie parallels between what was going on then and what's going on today. So there had been, from the late 19th century, a growing globalization backlash, particularly in agriculture, a little bit less in manufacturing, but trade barriers were rising. But even more important for today, perhaps, is the rise of geopolitical tensions between the superpower of the day, Britain, which had a policy of free trade, and Germany, the rising industrial policy, which had more of a policy of protection. And there were a lot of complaints in Britain at the time. Why are we the dumping ground for all these German goods? We don't have access to their market. They're a potential military threat, so there's a national security implication to trade. So a lot of the debates in Britain at this time very much echo what we're hearing today. And of course, it did end badly. You can see period 2 there. That's the deglobalization of the interwar period. A lot of protectionism, Smoot-Hawley, decline in labor migration, what have you. Then in period 3, we have the rise of the multilateral system. Now, when we say multilateral, however, it was a very limited multilateralism. It was really OECD, Western Europe, Japan, the United States, and a few others. In the GATT, it did not include the communist bloc. It did not include the global south. And so that's why 3, there's not a huge rise in globalization. But in period 4, after the fall of the Berlin Wall, starting in the mid-1980s with policy reforms, many more countries around the world become integrated. So it's important, too, to keep period 5 in historical context. We're coming off perhaps a very high level of integration. So that's a historically high level. We have to keep that in mind. So what is driving sort of the ebbs and flows of globalization over this period? Well, everyone in this room is familiar with Katz and Golden's work on the race between education and technology. Both are moving forward. It's just a race in terms of how relative wages will adjust. The same thing is going on in terms of global integration. There, it's a race between technology and policy. So technology is bringing markets together. But policy is sort of like driving a car. There can be an accelerator that can reinforce that, or there can be a brake that can pull back. So in the interwar period, they were working against each other. Technology is still bringing countries together, but policy more than compensated and pulled countries apart. But they had been working since World War II in tandem, both working in the same direction. And I'm sure we know, well, we can consider what were those engines driving that huge rise in the 80s, 90s, and into the 2000s. Once again, on the technology side, reductions in trade costs through transportation improvements, but also reduction in trade costs through multilateral and unilateral efforts to open up markets and reduce trade barriers. And I'll talk about how both of these are stalling. Now, in the first one, we're used to containerization, huge efficiency benefits from that. But what gets overlooked, and I think is missed sometimes, is the Airbus Beluga. So Airbus has about 5 of these in their fleet. They're massive aircraft. When you talk about the iPhone and containerization, this really deserves more attention. This is an amazing aircraft. So this allows Airbus to be constructed in Toulouse, which is not a port, and you can't bring anything on a railroad. So you literally stuff the fuselages and the tail fins of the A380 into the Beluga and bring it to Toulouse. So it's these sorts of innovations that really, once again, allowed for global value chains, but we haven't seen those innovations moving quite as the pace they did earlier in the 2000s. And in addition, what has been done in terms of liberalization. There was a great trade liberalization wave between 1985 and 1995, unilateral, but also multilateral, the WTO. The WTO has done nothing since 1995. So these two engines of globalization, technology and policy, have stalled for the last 20 years. And what that means is that the momentum behind globalization has slowed. And of course, we wouldn't expect the trade to GDP ratios to rise forever, that maybe we're just moving from one state to another. We can bring tariffs down maybe to 5% or zero, but can't get much more lower than that. So maybe there's sort of a natural evolution here. And of course, that's Herb Stein's law of if something can't go on forever, it's going to stop. We can't reduce tariffs below zero, so it's going to stop. Now, of course, whenever I put up Herb Stein here, I'm reminded of the very special party favor I received in attending his 80th birthday party, which is this Herb Stein T-shirt, which has never been worn. I've never had the occasion more than 35 years or so to wear that T-shirt, and I probably never will. But I still have it. So what are some other features of what's going on here? So Richard Baldwin has made an interesting point. If we look at the relative slow decline of the trade to GDP ratio, it's almost, well, 2/3 are driven by mining and fuels. So manufacturing is curtailed a little bit, but it's really these other factors. So what's going on here? First of all, this gives us a very benign interpretation for that leveling off. If it's mining and fuels, we're coming off a commodity supercycle. So it's a price effect. It's not a volume effect. And that really puts a different spin, if you will, on that leveling off. Another factor that's sort of important here is interesting is this deglobalization, if you will, is not so much only partly a U.S. or Western phenomena. We've seen the two countries that we talked about yesterday. Their trade to GDP ratios have really come down quite remarkably. It was remarked yesterday that India is still a relatively closed economy. That's a historical statement in recent history because if you look, when they had the license Raj, trade is less than 5% of GDP. That's a really closed economy. So they have closed up a bit perhaps, but this is sort of a puzzle. We can see the China shock there, but it would be highly unusual for the world's second largest economy to be exporting 35% of GDP. You'd expect that to come down to more normal levels, so perhaps this is just a rebalancing in some sense. India, of course, may be a case of moving inward, but both countries have moved in a different direction. Just a couple of concluding notes. First of all, no evidence of much deglobalization in services or in data. It would be interesting to look at capital flows too, but that's sort of a separate issue. And sort of lastly, what I think is interesting, and your point on resilience and where the Biden administration is going in terms of restructuring trade flows, there's going to be welfare cost. And so just as there are papers trying to uncover, to what extent are we deglobalizing, we also want to look at the welfare consequences of this fragmentation of world trade if we continue down this road. And the IMF has put together some very early papers on what the welfare effects might be. The numbers are, you can take them or leave them depending on how you look at the papers, but we're talking about 1% of world GDP or so, perhaps a bit more to the extent of fragmentation increases. So this is serious for the future of the world economy if the fragmentation continues on. But as Penny pointed out, it's going to be very hard. We're going to have a number of papers in the next 5 or 10 years on this phenomena because just take semiconductors, for example. It takes many years to build a semiconductor fabrication facility. We don't know whether the subsidies will work and what the impacts will be for some years to come. So I'm sure this will be a rich research agenda that we'll be discussing in future years. So in conclusion, just like the parrot in Monty Python, globalization is not dead, but it's resting. It's not ending, but it's evolving. And the big uncertainty, I think, is how much policy is going to continue to push and promote de-integration in the name of the environment, national security, resiliency, or what have you.
Thank you very much, Doug. We'll open up the floor for questions. Again, if you're on Zoom, please raise your hand. I'll start with Maury Osfeld and then Viral Acharya.
Thanks. A really nice paper and really illuminating discussions. So I guess at the beginning of the 20th century, a lot of people believed that, with the amount of globalization that prevailed then, war would be impossible. And, we found out that globalization, trade don't guarantee peace. But I think it's still true that trade is a really effective way for countries to project soft power, which is one reason behind China's initiatives on a regional trade agreement, on the Belt Road Initiative. And from that perspective, it makes me think about the TPP and how that was a huge own goal for the U.S. Friendshoring would look very different if the U.S. had actually gone into TPP than it does now, where countries like Indonesia, Indonesia was not a TPP country, but think about Vietnam, kind of feel betrayed by sitting through all these negotiations, then nothing happens, and that would be a huge boon to the U.S. in the current geopolitical conflict in terms of trying to line up middle-income countries on the side of the U.S., Ukraine, in its efforts. Conversely, friendshoring in the current circumstances I think can be quite reinforcing in a way that's negative. To the extent that the U.S. friendshores, that creates resentments, which make countries less friendly, which increases the need for friendshoring, and it's a dynamic that could lead to much more balkanization in the world economy. So I think that's something to really worry about. The other point I wanted to make was about financial globalization, where I think we have to be very careful about the metrics we use to measure that, because to a much greater extent than is true in trade, where I think the effects are negligible, if not absent altogether. There's a fair amount of financial transactions that are either of very low social value or negative social value. Think of tax evasion strategies. Think of the inflows to the U.S. that fueled the subprime bubble. So there, I'd be very skeptical about looking at those metrics and drawing a lot of conclusions. Conversely, I think really productive, socially productive capital flows to emerging markets are probably legitimately insufficient at this point.
Okay. Viral and then Ann Case.
Just two questions, Penny. One, I wonder if some of this has to do with the discussion we were having yesterday on emerging markets, on distributional consequences within the economies. I think ultimately the rhetoric has something to do with wealth and income inequality, lack of jobs at the lower end of the skill set. So I wanted to know how the empirics can be tied to those macro outcomes. And the second question I have is, it's intriguing that there is this differentiation between the goods and the services results, which is we just don't seem to be worried about anything on the services front. And on manufacturing, we continuously have this rhetoric. I'm not at all saying we should have the rhetoric on services as well. It just intrigues me, and I wonder if it has actually then something to do with creating the lower end of the jobs and keeping them within the country. Whereas, the services are slightly at the upper end as far as the services exports go.
Anne, and then Joe Gagnon.
That was all just really terrific. I was going to echo actually some of the things that Viral said. I mean, if you talk to the people who were economists in the Labor Department during NAFTA, they would say they understood that the jobs were going to be lost, but it was a time for upskilling, and that we would upskill. Well, the jobs were lost and the upskilling never took place. And I think the amount of pressure that has built on the system since that time, the feeling of disenfranchisement, the feeling of, and the rise of white nationalism, and I think that it may be that COVID and Ukraine were triggers, but it was relieving an enormous amount of pressure that's been building. And I think that that's just a really important part of the story. But a terrific paper, great discussion.
And Joe, and then Ashwar.
One of the issues that neither Penny or the discussants raised, and may not be the most important issue, but I think it's significant, is trade imbalances. There's new work by Philippe Martin and colleagues at CEPR and University of Paris showing that trade deficits are strongly predictive of protectionist policies, both multilateral and bilateral trade deficits. And as Penny showed, the two countries that are leading the charge in deglobalization, US and UK, are the two countries that have the biggest trade deficits. And of course, Donald Trump made trade deficits his #1 economic issue in 2016. Of course, the policies he chose had no impact on the deficit. It only got larger in his administration. So he chose not to talk about it in 2020, and the Democrats never raised it either. But it does raise a question, should we be talking about that in this context? There are policies that could work should they be used, things like foreign exchange intervention or capital info taxes. Could change saving and investment balances and thus deficits. Should they be used to minimize these imbalances, to reduce tensions?
So Doug invoked the Monty Python sketch, which might not have been the ideal illusion because the parrot was in fact dead. So, while people claimed it was living. As one looks at how corporate leaders seem to view the world, the world has always been risky, but they seem to face this panoply of big risks right now that leave them very exposed if they have lean and mean supply chains that run through multiple countries, because you have geopolitical risks, US-China trade tensions, climate risks, and so on. But even if you think about moving towards more resiliency, this takes a lot of time. So it's hard to rejigger supply chains on a dime, and especially at a time of relatively high financing costs. So if you look at other pieces of evidence, so for instance, what's happening with foreign direct investment flows, my long ago former employer, the IMF, has an interesting study coming out where they talk about this concept of geoeconomic fragmentation, where it looks like FDI flows are really realigning in a way that supports this notion that countries are looking to invest in each other based on how they are geopolitically aligned. So we might start seeing this in the data. But there is a question about whether this is really going to lead to resilience, because as you pointed out, Penny, if you have country-specific shocks or even region-specific shocks, climate shocks in a region, that doesn't leave you that much more resilient. But for corporations, it looks like there is an insurance value as well to leaving themselves less exposed, even if our models might suggest that there is a loss in efficiency. The other issue which I want to endorse is what you pointed out, that for low-income countries that are still not integrated into the global economic system, this is a very worrying time, because you have industrial policies that have this other aspect of protectionism that is becoming pervasive. In the US, we talked about the Inflation Reduction Act, the CHIPS Act, where countries of concern are supposed to be left out, and that can have a very broad interpretation. In China, you have the Made in China 2025 Act. In India, you have the Make in India Act. So if you put this all together, I think there is a real risk right now that a significant part of the world economy that never got to enjoy any of the benefits of globalization gets left out and accentuates what you pointed out, Penny, about greater global inequality.
John Holtwanger, and then Martin Sturmer.
So, great discussion. I wanted to build a little bit on the discussion on the difference between trade in goods and services. And I think a case can be made that we're significantly understating the growth in trade and services. So the service data that we collect is terrible compared to the goods data. We've known that for a very long time. If this has been accelerating, and you folks probably know better than I, but I at least know the data, and I think I look at the BEA surveys and I go, whoa, this is very limited in terms of what we're actually collecting. So maybe the story is not so much deglobalization, but a change in the balance of goods versus services would be very interesting. And be interesting to think about all the changes in the climate that you talk about, the political climate, in terms of that changing balance. And then last, kind of an aside comment, in meetings that I've been with, if we think about where do we think the growth is going to be coming from over the next decade. Of course, I don't know. Like we said, we can't predict anything. But in the meetings I've been attending, it's all about AI. And so that's the next big thing. And if that's true, this shift towards services may be even bigger.
Martin and then Steve Davis.
So Martin Stürmer from the IMF. So batteries for electric cars, they popped up very prominently in your charts there as being high risk. And I was wondering how you evaluate the impact of local content requirements. What is our experience with these type of policies in the past? How do you think will they impact the trade in batteries, but also critical minerals going forward? Thank you.
Fascinating discussion. I wanted to question the premise that geopolitical tensions and conflict are bad for growth and innovation, even if they do have sizable negative effects through trade. When I think back to the Cold War period between the United States and the Soviet Union, there was an awful lot of R&D that was funded by the U.S. Defense Department. I think of the space program as largely an outgrowth of national security concerns and geopolitical conflict with the Soviet Union. When I look at China in recent years, I see huge efforts devoted to trying to become the technology leader in what they view as critically important strategic fields, sometimes for national security reasons. Even the drive to produce to produce vaccines in the wake of the COVID had a geopolitical competition element to it. So it does seem to me that there's a possibly countervailing force to the negative effects of geopolitical conflict working through trade, and that it leads governments to invest more in innovative activities and to support more of that. And that could actually work in the opposite direction or even overwhelm the negative effects that you've identified through trade channels.
And Don Cohn.
Thank you. I wanted to reflect a second on the intersection of this subject and inflation. It often comes up in those magazine articles, always push on that. And I think the argument is very logical. Globalization, the growth of globalization is like a positive supply shock. It lowers costs, lowers the NAIRU probably. You can take it in lower inflation or lower NAIRU. Then deglobalization would be like a negative supply shock. The resilience raises costs, et cetera. And you have to have a higher NAIRU to keep price stability. But I was really struck by the charts that showed the peak in globalization at 2010, and then the decline beginning through the 20-teens. That was a period in which inflation had trouble getting up to the central bank targets, and the NAIRU turned out to be much lower than people expected going into the period. So the sort of the beginning of deglobalization didn't have the effects that people are talking about. So I wondered whether just how important for inflation further build up a resilience and a further deglobalization would be, or whether that argument has been exaggerated.
Jonathan Pingo.
Yeah, so just to follow on that, I mean, and I think Doug might know better, is, if you look at the last period of deglobalization that followed World War I and sort of started rolling over in 1920, I mean, that was a hugely disinflationary episode, even as the U.S. was also coupling that with more immigration restrictions. So it's not really clear. And to tie that back to the paper, it makes me wonder, the paper's really nice to talk about how there's no evidence, really, that there's deglobalization going on. If you look at the foreign direct investment flows, there's not really a whole lot of evidence. If you look at trade going through the post-pandemic shutdown period, I mean, the U.S. broadened its trading relationships and seemed to have deepened them as well. So I wonder if maybe, thinking about this paper and the discussion, I mean, maybe we should question whether we really are going to see that much deglobalization rather than just assume it's coming.
Okay, and back to the authors for responses.
Thank you very much. The discussions were excellent, and so were the comments. And I mean, personally, I agree with almost all of them, but let me just briefly address a couple of points where I think I may have something to add. Regarding the relationship to inflation, so first we need to distinguish between level and direction. So we may be moving towards a direction of less globalization, but still the economy is the world economy, incredibly interconnected. And regarding the effects on inflation, we have to think after the financial crisis, there was quantitative easing, there was very aggressive monetary policy. The asset markets were booming, and despite all this, we saw no inflation in the US. I have no econometric evidence to support this claim, but I think it's impossible to do a clean econometric study that would satisfy the rigorous robustness criteria used in micro work. But a simple correlation, a simple inspection of the trends would suggest that globalization had a lot to do with this, and perhaps for reasons that we are concerned about these days. So, for example, if as a worker you know that your job can be outsourced to a low-wage job in India or China, or the product you produce can be imported from a cheaper country. And the same thing, by the way, happens with technology. Then maybe you have less bargaining power, so you cannot negotiate for a higher wage. So I very much agree with Anne that all these developments, this exposure to globalization, put a lot of pressure on workers and labor. And perhaps this is why we are seeing this backlash against it. But I would credit all these things that we lament with actually keeping inflation in check in the past. Regarding Steve's point about the Cold War, so I think this is true that during wars we saw great leaps in technological innovation, but what we don't consider is the counterfactual. So what would have happened if this funding had gone to research to support peaceful causes rather than an arms race? So right now, many economists are very critical of the subsidies because they are concerned that the IRA, for example, may lead to a subsidy race. By the way, we're talking here about green subsidies, and this is an inefficient way of addressing climate change. And at the same time, we are willing to embrace an arms race as a way of inducing technological innovation. So I don't want to speak on behalf of Tristan, this is my opinion, but I find it very odd that we're willing to support an arms race, but not a green subsidy race. So I would, yes, I agree that if I look over the time, in the time series, it's true that wars and Cold War have contributed, but there should be in the 21st century, and after having suffered what we have suffered through in 2 world wars, there should be a better way of promoting technology. So that's my personal opinion. Some other issues regarding labor, integration of labor markets, I think this is a first order question. I think there is a difference to trade, and that's 2 differences actually. So one is that we don't see, when it comes to immigration, we don't see the bipartisan support we see right now that we see against free trade, and especially with China. There are, of course, some voices that are very much favor immigration restrictions, but there are also many who point out that we should keep the borders open to immigrants. The other difference is if we enter a phase where there are persistent inflationary pressures, for example, because the labor market is tight, as we talked about yesterday, or because we are distancing ourselves from low-cost trade partners, then it will be very important to keep labor flows, international labor flows, more flexible, because otherwise the inflationary pressures will become even more severe. So I think that maybe the pressures on the labor market may go the other way. Regarding service trade, I fully agree. It's the new frontier, but 2 points there. One is we start at a much lower level. So service trade is still not at its potential. And it's also not as liberalized as trade in goods. In fact, it's still highly restricted. One point that Doug made, and I couldn't agree more with that, is that the globalization, the hyperglobalization we experienced, it's due to a combination of technology and policy. It's both. So with services right now, with the development of AI and new technologies, we see the technological developments that could support much more trade in services, and this is the new frontier. But the policy is going the other way. So I think this is one more reason to emphasize policy developments. I don't, personally, in the current climate, I don't see any scope for more trade in services. Now, this may change again in the future. And finally, one point, and then I'll turn it over to Tristan. One final point about resilience and the cost of resilience and how likely is it that the world decouples from China, as Paul raised this issue. So let me just clarify what the export restrictions right now do with respect to China. The United States exports very little to China in the semiconductor sector. So American firms are not really affected. But what the new policies say is that any firm anywhere in the world, if they export advanced memory or advanced logic chips to China, they have to obtain a license from the United States. If they don't do so, then they're not allowed to use US technology or US equipment to produce the semiconductor chips. It turns out every firm that exports to China uses US software, US technology, or US equipment. So that means that these restrictions say that no one can export to China in these categories unless they have permission from the United States. Otherwise, they're cut off from the United States. So that's why I said before, it's really unprecedented and drastic, because it puts all countries, all firms located in other countries in a position where they have to choose between the United States and China. And this is a very difficult choice for most of them. So it's extremely costly, from an efficiency point of view. This is not something the private sector asked for. This is really top-down from the government. And so that's why I think what this policy change is really a game changer compared to the past. So I'll stop here.
Yeah, let me just respond to a few comments. Maurice, on capital flows, in the paper, in the appendix, we do have a chart with the series of Jesse Schrager and co-authors, which accounts for tax havens and also adds in portfolio flows. And there, if anything, you see like a stronger positive trend. So some evidence that other series work as well to show that there's no globalization. Stephen, on your point about innovation, I mean, I definitely take that competition could create more innovation. We do cite in the paper examples. There's some recent research showing that during the period in the Trump administration where the Justice Department was investigating researchers that were working with Chinese co-authors, you see actually whole fields that had more collaboration with Chinese researchers after those investigations. The research productivity of those fields and the US scholars go down, and scholars of Chinese heritage in America were hit the worst. So I think there is evidence. But even if innovation improves through competition, I think the thing that we'll lose are the ability to produce innovations at scale at low cost. So solar panels are a great example where people in the US lament that we invented these things and now they're produced in China, but they're produced in China at much lower cost, which has a benefit. Two more points. So I think on developing countries, there's just some very recent developments that I think show that trade is being diverted potentially more between high-income countries and less with developing countries. In the U.S. has now these two trade agreements with Japan and the EU about batteries and critical minerals. Note that the very little cobalt is processed in Europe. In fact, it all comes from the Democratic Republic of Congo. But it seems that the plan is to just export the raw material to Europe, let Europe capture the value added, as opposed to maybe, sending foreign direct investment to the DRC and helping them build value added. So, those are Indonesia is another country that has a lot of production, but it's not clear they're going to get trade benefits. And then finally, I want to respond to Paul. So he said it's Russia is very small, and the way we talk about it as a catalyst may not be right. So I want to just highlight what we mean. If you see in the U.S. Since I'd say the Obama administration in 2011, the Council on Foreign Relations publishes a book on geoeconomics, and in that book, the scholars argue that economists need less authority in international economic policy because they believe that things are positive sum when in fact national security concerns are zero sum. That has been building that intellectual push, but I think that the invasion of Ukraine made that very salient to the public, that type of risk. So I think that's the point we're making, that maybe the public is now more open to zero-sum competition than it was before. Thank you.
Thank you both very much, and to the discussants and the group conversation. We'll take about a 10-minute break, slightly shortened, and come back for our last paper.
It's called War by Other Means, and the woman has a Yale law degree, and she was the chief economist in the National Security Council for the last 2 years. Jennifer from Paris. War by Other Means. It's a book. But I mean, you read, yeah, and she, the way they talk, they're like, sorry, I didn't even. Sorry, I didn't. Forgot. What I wanted to make was that the national security people. I mean,
Hey, I'm Martin.
Which then see you. How are you? I think it's economists for you to do, but I mean, your point about the sunk cost and the adjustment being so high. I mean, I want to put a dollar value on that and compare it to,
I think it was in your discussion where you had this wonderful chart showing development of trade over different U.S. I was wondering individual income. It's not very a lot of countries that might be kind of security those guys are. What are your thoughts? So if you had to tackle the issue, the topic of fragmentation and commodity markets, there's something to be said about document the policy the last yeah. And that creating this. So I agree with that.
I think our point is just about salience for the public. So maybe that's not.
Yeah, maybe there's this whole thing where people there's still the perception that.
But when we think about these policies,
but I just don't want. Yeah.
My sense is.
I think what Putin has done is completely an own goal.
Stronger recently, especially after the pandemic. It's been very broad-based on metals markets already. But is there any work that you're aware of that looks a little bit?
So my take on that is I think that the people who.
I mean, ideally.
I mean, like take some example.
I think about it is.
Example.
We had the 80s, and then we had the breakup of the Soviet Union. And probably we had like 30 years of commodity markets naive. And then probably sometimes around 2010, similar to these charts, this probably has reversed to a certain extent and then maybe accelerating recently. But it would be great to have some sort of data that shows that this that the breakup of the Soviet Union has accelerated somehow. Yeah, and I think the point is really just to say, okay, this has all helped to fuel the economic growth that we have seen in the
press it. Oh, okay.
Test. Yeah, great.
If everyone could take their seats, we'll try to get started with the next paper.
They're heavily, sort of almost philosophically opposed to quantifying. Yeah.
go. Okay, the last paper of this season's conference is the health wedge and labor market inequality, and Owen Zadar will do the presentation.
Thanks. This is joint work with Amy, Casey, and Eric Swick. The gap in labor market outcomes between college and non-college individuals is really quite striking. It's been growing over recent decades. College individuals earn about twice as much in terms of annual wage earnings as non-college individuals, and they also enjoy much higher employment rates. There's a long literature in labor market inequality on what's driving this that emphasizes technology, things like skill bias technical change, institutional sources like decline of unionization, lowering of real minimum wage, globalization, and firms. And these forces have been affecting labor market outcomes in many countries, but the level and growth of labor market inequality seem especially pronounced in the United States. And uniquely American approach to financing health insurance through employers might have something to do with that. And so the way to think about the current setup is that we effectively have a head tax for full-time employment. For hiring an extra person, you have to pay a flat amount regardless of earnings for hiring someone. And that healthcare head tax has been increasing quite a bit with rising healthcare costs. And so leading economists, including Ann and Angus, as well as Saez and Zuckman, have conjectured that this healthcare head tax and the rise of healthcare costs play a potentially important role in terms of depressing the wages of non-college individuals, as well as employment prospects of these groups. And so what we want to do, and what we did in this paper, is basically ask, how large is the effect of the rising healthcare head tax on labor market inequality? And to borrow a phrase from Pohl, there's a high ratio of calibration to estimation. It's entirely calibration. And so we're thinking of this as not the final answer, but kind of a first step at trying to understand how important this is quantitatively. And so what we do is we develop and calibrate a very simple model of the labor market to try to understand how important this force is. And we have three sets of results. The first result is a counterfactual that asks, if employer-provided health insurance, instead of using a flat head tax per person, we're instead financed by a national payroll tax that's levied on firms that's kind of proportional to worker earnings. What would happen, we find that the college wage premium in 2019 would be about 11% lower, and there would be 500,000 more non-college jobs. The second counterfactual also is focused on 2019 that says, say we shrunk the healthcare head tax to Canadian levels, what would happen to labor market inequality? And we find that the college premium would be about 5% lower, and non-college earnings would be about 5% bigger. And then lastly, we can think about switching to a payroll tax, but asking, what would have happened over time to the growth in labor market inequality from 1987 to 2019. If we had used a different financing scheme in the lens of our model, we find that the rise in the college premium would be about 20% smaller, and non-college employment rates would have been 5% bigger in terms of their increase in that period. And so when you compare some of these numbers to other sources of labor market inequality that get a lot more attention, like outsourcing, the adoption of robots, rising trade, declining unionization, we think that this is a quantitatively important source, and it should get much more attention from policymakers and from academics. And so that's one thing I want you to take from our paper today. So what I'm going to do is I'm going to break up the presentation into three quick sections, a few background facts, talk about the model without any equations, and then go through the results. So one set of facts that's interesting, if you look in 2019 at two different statistics, one is how large health expenditures are as a share of GDP, or the college wage premium, which is the ratio of college wages to non-college wages. You can see the U.S. is really exceptional on both fronts. We spend much more on healthcare and have a much higher college premium than other advanced countries. Now, if you look kind of over time, that gap wasn't always so big. We have some figures in the paper that kind of track how this has evolved over time, and it seems like things were closer in 1977. If you focus here on this graph and just look at the US case, health expenditures as well as the college premium have roughly doubled since 1977 in the US. Now, a couple quick things on employer-sponsored health insurance. About half of the US population gets their insurance through employers, and almost everyone with private insurance gets it through their employers. Now, this is a very large tax expenditure. It's in fact the largest because we do not include in taxable income contributions from your employer. Most economists would not set it up this way if they are asked, and that's in part because it's regressive. We have a progressive tax schedule on labor income, and it distorts compensation towards health insurance. So those are a few background facts. We have a lot more in the paper, which I invite you to read. And so the way that we're thinking about quantifying what this does to labor market inequality is in the simplest possible way. And so what we did is we set up a perfectly competitive labor market with a simple constant elasticity of substitution technology that combines labor services of college and non-college individuals. And from the firm's perspective, when they're thinking about hiring a college individual or a non-college individual, they just combine the total cost of wage payments plus employer contributions for their health insurance. On the supply side, workers make an extensive margin labor supply decision, and they think about that decision based on what that is going to do for their wages, the amenity value of health insurance. So there's going to be one parameter we'll talk about in some of the tables called alpha that governs the relative importance of health insurance to labor supply relative to wages. So when alpha equals 1, that means people are equally happy in an indirect utility sense with getting $1 of wages or getting an extra $1 of health insurance. And then finally, we have idiosyncratic taste for work. And so it's a very simple, highly stylized labor demand and labor supply setup that's in partial equilibrium. We don't have any kind of rich frictions that prevent workers from getting anything different than their marginal product. There's a representative firm, and so again, I want to emphasize this is kind of a first step, but it's not the final word, especially because we shut down a lot of other margins of adjustment, like anything that's not wages or employment, such as part-time work or changing how generous insurance is. Okay, and so with this very simple model, we do two types of counterfactuals. We have a national payroll tax on firms, where we set the payroll tax such that firms can offer employed workers health insurance at the exact same cost as in the current equilibrium that is more of a head tax equilibrium, where there's a per worker fixed amount. And we think about outcomes in 2019 as well as outcomes changing since the mid-'80s. And then the second counterfactual is just taking that head tax and shrinking it. How much we shrink it is from the U.S. Healthcare expenditures as a share of GDP level, which is like 17%, to a smaller share of the Canadian share. And we look at outcomes in 2019 from doing that. And so economically, I think it's helpful to think about what this does in an even more stylized version of the model, where it's not CES demand, but it's just a linear technology where wages are effectively pinned down by productivity of the two different groups. And so if you think about the labor market for non-college individuals and college individuals, on the demand side, wages will be pinned down in the current environment by the productivity of each type of worker. So for instance, on the left, look at non-college individuals. The productivity of non-college individuals after you deduct the cost of this head tax is going to determine wages for non-college individuals. And when we go to this payroll tax regime, because non-college workers earn a smaller amount and we're charging them a proportional amount of that, they're going to basically have a labor demand increase. And conversely, college workers will have a labor demand cut. And so when you apply this payroll tax on firms from a statutory point of view, what that's going to do is it's going to basically be moving along the supply curve, and the relative supply curves where in this graph we're plotting on the y-axis the college premium, and on the x-axis it's relative quantities. And what you can see is that this reduction in labor demand for college individuals relative to non-college individuals will improve things in terms of reducing the college premium and also increasing the relative employment of non-college individuals. The second counterfactual of just shrinking what the head tax is basically boosts labor demand for both groups, and what that does in terms of the college premium depends a bit on the amenity value of health insurance. So we kind of in the first version of the paper, we emphasized this more because we didn't have to take a stand on the amenity value of health insurance. In this graph, we're showing a version where the amenity value of health insurance, so $1 extra of health insurance is worth the same to people for both groups as $1 of wages, but in the tables we kind of explore different versions of that. And what you end up with is a lower college premium, but the same level of employment in that case. Okay, so I'll turn to results. I see I'm running a little slow on time, so I'll go through this a little quickly. So in terms of calibration, we focus on full-time, full-year workers who are aged 25 to 64. By full-time, full-year, I mean worked more than 40 weeks out of the year for more than 30 hours. And college workers earn a little under 100K, and non-college workers earn about 50K. And college workers have an employment rate relative to population of about 76%, whereas non-college are about 62%. And we use an expression for labor supply elasticities that give an extensive margin elasticity that's a little higher for college and non-college workers, but we also have some robustness that just directly calibrates labor supply elasticities from micro and macro literature. We take a CES parameter from recent work that's updated the race between education and technology, and then the most important calibration term is how big this healthcare wedge is. So if you look in the data, the average premium is about $12,000, and for a family plan that's as high as $20,000, but the average is 12, but not everyone actually receives coverage, and so what we do is we scale down that $12,000 amount by a third to account for the fact that not everyone is a policyholder. So basically the wedge that we're going to be working with in our counterfactuals is a little under $8,000. Okay, so for the three counterfactuals, what does that do? So if you go in 2019 from a world where we have an $8,000 head tax to a proportional payroll tax, what that does is it lowers college wages by about $2,000, increases non-college wages by about $1,600, and that changes the college premium by about 11%. For the sake of time, I'm not going to talk about the full coverage column. That's a world where you, instead of having the wedge be $8,000, take the full wedge of $12,000. Okay. The employment impacts are such that you'd reduce college employment by about 400,000 jobs. You'd increase non-college employment by about 500,000 jobs, and on net, that's a little under 100K total jobs. And then over time, I'm going to move forward for the sake of time. What this does is it lowers the college premium by about 20%. And so one thing that we wanted to do is say, okay, how big is that relative to other explanations for what's going on in the labor market? And I'm not going to be able to go through each of these papers, and the outcomes are kind of measured differently, but it was kind of interesting that these are pretty material, and for instance, like half a point of non-college non-employment is like a $500 increase in import exposure or a doubling of robots based on recent estimates. And there was a nice binder and bound JEP paper that went back to an old Brookings discussion about the role of trade. And there's a 2008 Krugman BPEA paper that said, that was trying to quantify the effect of trade on labor market inequality, and Larry Katz said it could be no more than 20%. Now this was before the work of Otter, Dorn, and Hansen, and so maybe it's a little bit an even update, but our takeaway from doing this exercise, which we're much more careful about in the paper, is that the effects of the healthcare head tax kind of rival a lot of these stories, and so deserve a lot more attention from folks in this room and other policymakers. Okay, so I'm going to skip the Canada counterfactual because I have about 10 seconds left. And so where does this leave us? We think that the basic answer of how important is this source that people have conjectured is potentially quite important. We think it is fairly important. And again, this is a first step towards quantification. There's a lot of interesting things that we didn't model. I think if you look at the frontier of the inequality literature in the labor market, there's a lot of emphasis on rents or firming up inequality. We didn't incorporate that, but I think there's a lot of fruitful work that could be done on that front. Generally, I think this force of rising healthcare costs hasn't been as much in the forefront of discussions of U.S. competitiveness, but we think that the way we're financing health insurance is potentially linked to some of the forces that we've seen in the labor market in terms of rising trade. I also think it's plausible that if you kind of take the model we wrote down and extend it to 3 groups where the bottom group is eligible for Medicaid, this could contribute to the hollowing out of the labor force. And so the bottom line, with the caveat that it's hard to make predictions, is that if healthcare costs continue to grow, absent reforms to how we finance it, we find it likely that the rise of healthcare costs will contribute to the growth in labor market inequality. So thanks very much.
Thank you, Owen. The first discussant is David Cutler.
Thanks. This is just a terrific paper to read and to discuss. And so thanks to the authors for doing a great job with it and for inviting me to discuss it. I'm going to do a couple of things. First, I'm just going to very briefly summarize the paper, and then I'm going to give some comments on it. I'm not exactly sure how to pronounce the paper, although I will stay away from any comments about fuzzy thinking as we go on. So employer-sponsored insurance is currently a head tax. That's the way it sort of comes, that is or at least partly it comes as a price per person. I say partly comes because typically a firm is presented with a whole health insurance bill as opposed to a price per person, but when there are more people, the wage bill goes up, or the health insurance bill goes up. This causes employers to reduce wages, and so therefore if it were a payroll tax instead of a head tax, notice by the way that you can only do privately the head tax version. You can't do the payroll tax privately because otherwise you have to be equal for every firm. You have to collect the right amount of money for each firm. So you would see a shift in wages, a shift in employment, and then the bottom line conclusion, which is really interesting, is that the magnitude of these is comparable to other economic changes that have reduced the opportunities and the outcomes of the labor market for less skilled individuals or people with fewer years of education. So I want to note a couple of things. The first thing is an implication, which is that one implication of the work here is that when we focus on wage inequality, we really shouldn't be focusing on wage inequality. We should instead be focusing on compensation inequality. So, and we sort of knew that is like, compensation is really what we care about for individuals, especially if the individuals value the compensation at cost, then you really want to just trade off the wage and the benefits in terms of counting them together. And so this is sort of like a nice reminder that we ought to be thinking about that. In terms of what that would actually mean in terms of focusing on compensation inequality instead of wage inequality, I'm grateful the authors and I had a lovely set of conversations back and forth, and so this is actually from the authors in terms of what that means. The best evidence from Pierce is that differences in compensation inequality are not actually that different from changes in compensation inequality are not that different from changes in wage inequality. And you say, well, how can that be? And the reason is that sort of in the middle, what you wind up giving to people is a lot of health insurance costs, especially as a share of compensation, that's a bigger deal for folks in the middle. But at the high end, you then wind up with a lot of pension benefits and other kinds of benefits. And so the net effect is that the growth in compensation inequality looks kind of like the growth in wage inequality. So, okay, maybe I don't need to worry about it that much. But on the other hand, that does suggest that potentially some of the incidence of the rising health costs may be on the benefit side. So it may be that what's happening here is that, when the health insurance costs go up, the firms say, well, okay, we're going to have a 401k that's really tilted towards high-income people, and we're going to sort of contribute a lot for high-income folks, and we're going to do a lot of other sort of other compensation. That then means that, if you come back, that then means that the impact of the head tax on the wage inequality may not be as big as one gets, just assuming that all the other benefits are fixed, which is kind of what's happening in the model here. So I think that's sort of important to be thinking about that here. The key issue that you need in order to do something like this is obviously you need an incidence version. This is, I sort of feel sort of pleased to be discussing this here at Brookings, because if you go back to Joe Peckman when he was writing books on what's the incidence of the tax structure, like sort of out of Brookings came this kind of model of like, how do I think about the incidence of different kinds of taxes, and therefore what is the net burden of tax collection in the U.S. And so you have to be very explicit about the incidence, and the authors are very explicit about the incidence, so that's great. So their incidence assumption is that total compensation is equal to marginal product of labor for all workers. That is, it's a fully efficient labor market. And now, and that's in both the sort of original head tax situation, and it's also in the payroll tax situation. It's easier for me to believe that because we have a lot more evidence on the payroll tax side than on the head tax side, on the sort of health insurance part side. So I'm kind of fully willing to believe that a sort of percentage payroll tax is roughly going to be offset at the worker basis, although not everybody does, but I'm much more willing to believe that. On the head tax side, we don't have a ton of evidence that way. So there are a couple of papers. They tend to be old. There not very many studies and so on. So we'd really love to see a little bit more. And the reason why this sort of particularly occurred to me is because, like, in their model, as in all efficient markets here, the firm doesn't care how much it's paying for healthcare. It's just whatever. Healthcare, the workers value healthcare. If they want me to pay them in healthcare, I'll pay them in healthcare. If they want it in wages, I'll pay them in wages, whatever it is. The healthcare is tax preferred, so we'll do that, and so on. And so what's kind of not happening in the model at all is there's nothing on the labor demand side. Everything is like all the employment changes are coming from labor supply because the wages change, and and workers decide they want to work more or less or something. But there's not much happening on the labor demand side. Yet we know that sort of from a bunch of different types of evidence that we want to be thinking about the labor demand side is really important here. So, for example, there are large firm effects in wages, right? So this comes out of David Card's work most recently and a bunch of other firms, a bunch of other folks' work that roughly 20% of wages can be explained by firm effects. Firms certainly seem to care a lot about healthcare costs. That's the chart on the right. Of course, they should always care about their costs relative to their competitors' costs, because that puts them at a competitive disadvantage. But they seem to care about overall costs as well. They get really mad when everybody's health insurance costs are going up. And one of the things that is interesting that I want to come back to is that there have been big changes in the structure of plans over time, which firms attribute to rising costs. That is, they say because costs are going up, we're making our benefits be less generous, which they wouldn't do in this model here, because they would just pass that back to wages. They would have the optimal insurance policy, whatever that is, and then they would pass that back to wages. So that sort of led me to think about what is the sort of alternative, like if you were thinking of a model of incidence or just in general of the employer-sponsored health insurance market, what sort of model would you have as an alternative? I didn't sketch it all out entirely, but here's kind of where my brain was going on this, so I'll sort of suggest some parts of it. First is the obvious sort of model you can think about as one of nominal wage stickiness, where the firms can't reduce can't reduce wages for certain types of workers, or can't reduce increases in wages in some particular circumstances. So that model has sort of been worked out a lot, so I'll kind of leave that aside. Two sort of interesting things that I think are relevant. The third one I'm going to follow up on the most. The separation of benefits from wages. In a lot of firms, as I said, what they get is they get a bill for health insurance, particularly if they're self-insured, so your university or a big employer, whatever it is, gets a bill saying here's what the cost is. And then, sort of what happens inside the firm is that then gets paid out. And then there's a sort of benefits group, and then separate from that, I think, is often a wage-setting institution, which in the model here, as in most of our models, they would be integrated. But it's not entirely clear to me that that's always what's done in firms. And so so at least part of my model is that the firm pays the bill, and then at the end of having paid the health insurance bill, it then thinks about the wage bill, and then maybe what's left over gets distributed in sort of bonuses or other kinds of distribution to high-income people or to executives in the firm. So if you had that kind of model, you could get a different kind of incidence out of this, that some of the incidence of, say, health insurance for middle-income folks might be on the residual amount left for higher-income executives. Again, I don't have any empirical evidence. I was just trying to think about ways that this could play out. And the third one is really sort of gets into the labor demand part. And so here's where I want to spend a little bit more time. And it has to do with what is the valuation of health insurance. And so in the paper, the authors tell you, and in Owen's presentation, he was actually very, very clear about this, which is you have to make some assumption about how employees value the health insurance benefits. And so they make an assumption that they value them one for one at the margin. And it's not clear to me that that's true. And so I wanted to think about a different model. And the model that I was thinking about was at least inspired by facts that we have about changes in inequality of wages over time. So actually, Owen even mentioned this in terms of what are the components to increased inequality, and there are basically three of them. There's more sorting of higher paid workers to higher paid firms. I think that's probably independent of whatever is going on with health insurance stuff. There's segregation of higher paid workers to the same firms, that is, higher paid workers moving into firms with other higher paid workers and so on. This could very well be related to health insurance. That is, we don't want to have a big mixing of high and low paid workers, and why might we not want to do that? Because of benefits cost is one reason why, or fixed benefits cost is one reason why. And then the third one is declining wages for low-wage workers in what are called mega firms. I didn't invent this. This is a sort of technical term. Mega firms, think of as the roughly 750 firms that have over 10,000 employees. So many of the firms you sort of think of first come in there. And this one obviously seems like it could be related to health insurance costs. Just to give you a sense, the chart on the left here is showing you, this is from Song et al., is showing you the wages of high school graduates or less in mega firms compared to somewhat smaller firms, and the one on the right is showing you for college graduates. And you can just see like this absolute decline in wages for low-wage firms and the mega firms. And that was sort of the David Card, 20% wage premium for working at Apple or Microsoft or wherever it is that now seems to be declining over time. Okay, so then this led me to the theory, to where I was thinking about in terms of the theory. And so at least the driver for where I was going in the theory is that recent cost increases are probably not particularly valuable, especially for low-income workers. And so why did I start off with this assumption? Well, one is sort of thinking about the nature of what is going into cost increases. So one part of it is sort of new stuff. And that new stuff, like think about a drug for a condition like rheumatoid arthritis, that's one I keep in my mind. Rheumatoid arthritis, as do many conditions for which there's been a lot of innovation, has the feature that if you have it with certainty. And if you don't have it, the probability of transitioning into it is low. Not zero, but it is fairly low. So therefore, if I'm a 50-something-year-old and a new drug comes out for rheumatoid arthritis, and thank the Lord I don't have rheumatoid arthritis in me or my family, and I don't care a whit, or I care very, very little about it. Whereas if I have it, I absolutely know that I have it and I need it. So what's the implication of that? The implication is that the marginal value to the vast bulk of people who do not have the condition is very low. Because I know with fairly high likelihood whether I'm going to have it or not. And I know much better than the average share in the population, which is what the premium has to be based on. So in other words, it's going to create a lot of incentive selection sorts of issues. Anything for a defined group that's targeted where the flow into and out of it is less than this, is not particularly rapid. So there's been a lot of those sorts of things. If you look here, this is just showing you, like, if you said, what is it about health costs that are rising most in terms of the quantity side, you would say it's new medicines in particular. And the new medicines are like really skewed on the upper end. That's what you're seeing here is the upper end is moving out a lot. And it turns out, you can't see it from this, but if you look at them, a lot of them are very targeted conditions where, the flow into and out of it is not particularly high. Second is some of the increase as a result of administrative costs and provider rents. So prices to providers are going up and administrative costs are going up. That has relatively low value. And then third is that within any plan, people are shifting to use higher price providers. And actually the people who are shifting most to use higher price providers are higher income people. So think about the fancy teaching hospital in downtown wherever. And the people who are most increasingly going to the fancy teaching hospital in downtown wherever are the higher income people to see the fancy docs in wherever. And so that's going to wind up being a benefit to them, but raising costs to others in a way that's not so valuable. So as a result of this, I'll just sort of show you where my non-technical theory went. So therefore, you're going to want to have higher cost sharing inside the plan because it's valuable for most people who don't have rheumatoid arthritis to charge a ton to people who have rheumatoid arthritis. And besides, you don't actually care if those people leave the firm or not. So a third of people in privately insured plans now have high deductible plans. That also then tends to reduce the value of insurance. That's what I was talking about. So the value of alpha falls because, for all those reasons, very, very few of them are super valuable. And then the implication is then going to be a lot of the things, and ironically, a lot of the things that the authors point to as being comparisons to the impact of health insurance. So I'm going to want to outsource folks that way, and I'm going to want to bring in robots, and I'm going to want to have gig work, and all of that sort of stuff, because the marginal value is falling. So in my mind, what I want here is not a different theory, but like a richer theory that shows me more about what it is that's going on, particularly on the labor demand side and on the valuation of insurance side, that's then going to lead to some of these. My guess is, that theory will say the impact is higher because, I'm not going to have a separate part, which is the gig economy, and a separate part, which is outsourcing and so on, but they're all going to be tied in there. I'm not saying this is the only thing going on, but just that I think it might tie some of this together, and it'll then bring up an issue which they bring up, which Angus and Anne have written enormous about, which is about the drag from healthcare inefficiency. So I'm over, and I'm taking into Angus's time, so I'm just going to stop there.
Thank you, David. The second discussant is Angus Deaton.
Thank you. So my comments are like David's. I like this paper a great deal. And also they're very complementary in both senses to David. I liked what he said, and I'm going to talk about really some rather different issues. I thought you might be interested to know how we got here. When we were working on our book, Deaths of Despair, we were looking for economic factors that were implicated in distress among workers, especially those without a BA. So, the obvious candidates, which are the same candidates that are in the paper, are sort of robots, or globalization. And the reason we were looking for something else was simply because other rich countries face those too. I mean, they have globalization in Britain, they have globalization in Sweden and Holland, but they didn't have the increases in suicides, alcohol-related mortality, and overdoses. And there are a few exceptions here, especially in English-speaking countries and to some extent in Sweden. So we were looking, and this is quite a late stage in developing the book. So we're sort of looking for a smoking gun. We were looking for another factor that hurt less educated people in the US relative to Europe. So we knew that healthcare was something that was just very different here from what it is in other rich countries. It's much more expensive, and it's financed differently. The other thing, which we still have not given a great deal of attention to, is the much weaker safety nets in the US relative to other rich countries. So we have a friend, a relative, who works for, or I think he's retired now, he used to work for a large US chemical company, and he's a sort of arch conservative, and it's always good for us to talk to such people because they hate what we write, but some of them are smart, and he's actually one of them. So this was really very useful for us. And he told us the following story, that one year they had a meeting with their benefit managers, and the benefit managers came in and said, if we don't change our policies and what we're doing now, our health premiums will be 40% higher next year, right? So this causes some consternation, sort of chaos in the C-suite. So they bring in McKinsey, and they say, what the hell should we do here? And McKinsey says you lose those whose premiums are high relative to the value of their company. So you order people by that difference, and you get rid of the people at the bottom. You outsource everything that can be outsourced, or you rely on the gig economy and so on. So a lot of good jobs, those were good jobs in the sense they weren't high-skilled jobs, but you were working for a large multinational corporation, and those jobs were gone. So few large corporations now employ their own security, drivers, cleaners, food service workers, and many of those were good jobs in some dimensions at least. Social dimension in many ways, you belonged. Because premiums don't vary with wages or skills, the people who get outsourced are the less educated people. And so outsourcing here was seen as a consequence of health costs and wages, or at least part of the story. So the cost and financing of healthcare through a flat tax came to be a key part of the story in our book, but at a fairly late stage. So, you know, we went to literature to look for this and didn't have a lot of luck. We talked to labor economists, some very, very distinguished labor economists with Nobel Prizes, and they looked at us like we were nuts. You know, what are you talking about? You mean to say there's a flat tax that funds healthcare? What would that do to the labor market? So we wondered if we'd lost it somehow. So, and one of the parallels we drew was, you know, there's a mountain of work done by a mountain of labor economists on the minimum wage, but nothing on this. So what was going on? So when Sayers and Zuckman's book appeared, while our book was in press, we were delighted to see that we were not the only people in the world who thought this. And we're further delighted to see that the wedge is being taken seriously in this paper. They do a very good job on things that we didn't do at all. That's terrific. Of course, like us, there's not exactly a mountain of empirical work that tells us how important this is and really says, does it work the way we're talking about here? So I want to talk about a little more broadly and setting this in the context of Anna and Mai's work. I want to note that these higher than necessary healthcare costs, the inefficiency that David was talking about, oppresses us all, and especially those without a college degree. So it's not just them, it's us too. So 18% of GDP being sacrificed to this monster means that many, many other things are sacrificed and we can't have. The paper talks about the largest tax expenditure is these things, for instance. But this is a transfer of resources from employees, to hospital executives, pharma, some docs. Owen in his other work has talked about some of these very, very wealthy physician practices and device manufacturers and so on. So several calculations, including one by the IOM, argue that it costs us about $1 trillion a year in excess costs, judging by expensive places elsewhere, like Switzerland, for example. And for comparison, the total military expenditure in the US is less than $1 trillion. So, you know, just from the waste of healthcare, you could finance the whole of the US military and have a lot of money left over. So I'm not arguing that the system does not improve our health. And, you know, I'm a great fan of Bob's work on how we should spend more health as we get richer. But this is not that. This is the inefficiency bit, that we could get what we have without paying so much for it. And just to show some of the stuff that's happening, here's men on the left and women on the right. This shows the top left, the top figures are for cardiovascular disease mortality. This is from 92 to 2020. And also what Ann and I call deaths of despair, suicides, drug overdoses, alcohol, liver disease. And you can see that CVD has stopped falling. So that CVD, which was the driving force for mortality decline and life expectancy increase in the US since the last quarter of the 20th century, has now stopped falling and is actually rising for people with less than a BA. These are the curves, the broken curves. Sorry, the top ones are for people without a BA. The bottom ones are people with a BA, lower mortality. And you can see that this is the great puzzle, the great change in recent years, that mortality from cardiovascular disease, which has been doing wonderful things for us, has now stopped falling and is rising at the bottom. The same is true for women. Cancer mortality has fallen for both men and women and for both people with and without a BA. Everywhere, though, there's lower progress and higher mortality for people who don't have a 4-year college degree. So this is a question of, what are we getting for all this money? I remember, I think the first talk I ever heard David Cutler give, and he may not remember this, he had a graph of cancer mortality, and he had a vertical line which says Nixon declares war on cancer, right? And there was a line for cancer mortality, and it was absolutely horizontal. And the Nixon declaration of war had no perceptible effect on this curve. That's not true anymore. So if you draw these cancer curves, they're going down. It's mostly lung cancer, but there's also declines in colon cancer, ovarian cancer, breast cancer for women, and prostate cancer for men. Much of that is to do with the medical system. So there's, we're getting something for our money. Okay, so the final line is, where's the beef? What are we getting for the cost? I wanted to talk a little bit, this is not a central part of their paper, this appears in the appendix, but I was sort of stunned by this picture, which shows real earnings by education, college, non-college, and employment rate. There's a chart in our book, which Anne has updated, and it shows median real wages for people without a BA on the left, and employment population ratio for people without a BA on the right. And all you just want to know about these is that this is much worse than the picture they're giving you. Now, why is that? Well, they have men and women together, and women have been doing relatively well, at least until recently. They deflate by the PCE deflator as opposed to the CPI deflator. Now, for many purposes, that doesn't matter very much, though I think even macroeconomists have become worried about that in recent months. But if between 1980 and 2020, there's a 16% difference. So it actually matters for these long-term things, and it matters for looking at, say, poverty and so on, which of these deflators you use. The different weights, that's most of it. The PCE uses more medical care, and the CPI uses more housing. So you could argue about that in various ways. I just want to note along the way that the CBO, when it calculates inequality, adds these benefits into worker income, what they call market income. And I very much agree with David about the falling alpha over time. And so you get this paradoxical situation where you're reducing poverty by letting monopolistic hospitals merge and get even bigger, all right? Because it increases the cost of healthcare, and we count it as a benefit to the people who are receiving it. Not a benefit to people who get fired, of course. What I worry about more, and I've changed my mind a bit about this over the years, is both the CPI and the IPD of CE use hedonics to adjust for quality. Quality change is not something we understand. We have some models of it, but I don't think, the thing about these models is they're very good for some things where quantity substitutes quality perfectly, like, gas that gives you twice as many miles per gallon. That's quantity adjustment, price adjustment, easy. But many new goods and services replace old goods that are no longer available. And it's clear when you think about it that many quality changes cannot be reduced to quantity changes. Now, for instance, I have 2 hip replacements, one on each side. Okay. The one on the left was done earlier than the one on the right. The one on the right, by hedonic methods, is twice as good as the one on the left. So I actually need 1 hip, according to the way that the hedonics is done. But, I'm going to try and get back to my seat on my right leg. But, I mean, it's a silly example, but there's lots of other examples where the way we live our lives is changed around the technology, and the benefits that may have been there when it first came online may not be there anymore. I don't have a suggestion here. I don't know how many of you know about Oren Cass's CODI index. It's called the Cost of Thriving Index. He says, this is a quote, it's through 303, the median well worker needed 30 weeks of income to afford a house, a car, healthcare, and education. By 2018, the CODI had increased to 53. A full-time job was insufficient to afford these items, let alone others that a family needed. Now, he's picked fixed items. He's not making hedonic adjustments. And I'm not endorsing this specific number. But I think the way we deal with this quality is not correct in general. And I don't know how to do it. And it's important. My friend Erwin Dewart, who knows more about prices than I've forgotten, sorry, other way around. He's forgotten more than I ever knew. He likes to say that in the old days, welfare improvements through goods were in quantity, and now welfare improvements through goods is mostly through quality, and we don't know how to count that. But, I've always been opposed to the Boskin Commission recommendation to subtract 1% a year from PCI growth, and I'm beginning to think maybe we should be adding 1% a year to PCI growth, in which case things are really bad for these wage series that I just showed you. So let me wrap up just by showing you some other things. This is the thing that we think should be engraved in the profession's mind, which is, nothing else is worth much if you're dead. And, life expectancy, which many people would regard as sort of key measure of whether society is flourishing or not, has actually stopped going up for people that are BA, even before the pandemic. So it's just flat from about 2010. Maybe this is the hyper-globalization. Certainly wasn't doing very much for these people. And if you look at what happened during COVID, this is the first 2 years, 2020 and 21, it felt like a rock for people without a BA, for reasons that you can imagine, and not nearly as much for people with a BA. So not only, is the world coming apart, it's just terribly coming apart for people without a BA. And you can argue about whether we're measuring their consumption right or their incomes right, but when they're dying in droves, you really do have a problem. Here's one of my favorite pictures from the Fed. This just shows, if you go back to 1990, half of all wealth in the US was held by people without a BA. Now it's about 20%. The ratio per capita has not changed very much, but that's actually not much consolation. The ratio per capita wealth for BA, non-BA is a little lower than for whites versus blacks, but it's very similar and it hasn't changed much over time. People without a BA have the lowest expected years of marriage since 1890. There's rising pain for people without a BA, not for people with a BA, and much more. So, I don't want to claim the healthcare system counts for all of this, but something really bad is happening to these people, and it's time that we sort of figured out what it is. And just to note, before someone else does, I've been in this room and brought up for the same thing. Some of these differences are possibly being driven by the increased fraction of those with a BA. So the people without a BA are selected. But these gaps don't necessarily signed by that selection because both outcomes are going down by the moving of the people from the bottom to the top. And the calculation Anna and I are trying to do on life expectancy, not much of it can be explained that way. This is not for people with less than a high school degree, which is a very different calculation. Okay, I think I'm done. Yes, thank you. Sorry, I probably went over my time, but I don't know how to read this thing, and I'm just getting back on David, so thank you.
Thank you, Angus. So we'll open it to the floor, and we'll start with Neil Marucha.
Here we go. Just a quick question for the authors. To the extent that you see U.S. healthcare expenditures relative to other countries as a subsidy to providers, would that mechanically increase the college premium to the extent that most providers are college educated? And I'm wondering if you'd done that calculation.
Okay. Adam Looney?
Sorry.
Thanks. I guess I'm a little skeptical for three reasons of the importance of the wedge. One is that I thought Brooks Pierce's, as you said, Brooks Pierce's paper suggested that compensation inequality increased at the same pace as wage inequality, and that sort of bakes in that wedge. Second thing is that I thought that health insurance is not a poll tax. It's actually quite progressive. And so the Affordable Care Act, for example, requires all employers to provide the value of the premiums that they pay to their employees on a W-2. And so from that data, you can see that the top 10% of employees get 21% of health insurance payments. And so it is not, as progressive as a poll tax would be, as a payroll tax would be, but it's not a flat tax. And then the third thing is that just in the time series, I thought the big change over time was a decline in health insurance, particularly at the low end. And so, the amount that over time that employers are paying for their low-income workers has been declining just because they've dropped coverage.
Melissa Kearney?
Oh, thanks. Thanks for this. This was really fascinating. I guess I was wondering if you could check your calibration with some estimation. And what struck me was that you didn't really mention any change post-2010. And I would have thought, after all the changes of the Affordable Care Act and the great expansion in Medicaid and equilibrium, we should have seen fewer low-wage, non-BA workers getting health insurance through their employers, in which case that would have led to a shrinking of the college wage premium. I was just wondering if you even saw that descriptively in the facts.
Okay. Ashwar?
I was amazed at David Cutler's bravery in tempting fate by mentioning a disease that he does not have. At least Angus told us exposed about his excellent hip, which he already has. More substantively, right now, employer-provided benefits now account for about a third of overall compensation packages. So it's interesting that you focused on health benefits, and there's a good reason why, because you think about it as a fixed cost, but there are other elements of the compensation package that are fixed or at least have a nonlinear element, such as Social Security contributions. So one question is whether there is a broader implication of these fixed or quasi-fixed costs in the benefit package that might, sort of amplify what you're doing. And then picking up on what Adam pointed out, if you look at compensation and wage inequality, that hasn't been very different in terms of the overall trends. But here again, there might be an issue about whether you think about these different aspects of non-wage benefits that might affect the dynamics that you're talking about.
John Haltwanger, and then Adele Morris.
So again, fascinating exercise. I guess I'm, when I say a little bit skeptical, but interested in whether you can account for some of the patterns we see in the data. So I'm going to build a bit on what David Cutler talked about in terms of firming up inequality. That very nice work. So in recent work, also building on that with census data rather than the SSA data, one strength of the census data, we have much better industry codes. The SSA data that the Song et al. Used were both had a high degree of missingness and were poor codes. So as we brought the industry codes in, we found that actually most of the rising between firm inequality is rising between industry inequality. But then I'll say it's even more striking than that, is it's actually only 10% of industries doing virtually all the work. So there's by 10% of four-digit industries. So there's about 300 four-digit industries. It's 30 of them that are doing virtually all the work. They're kind of the household name industries. We spend a lot of time as our poster child in the discussion here. So there's 19 industries at the top. That includes literally every high-tech industry you can think of, and finance and offices of physicians, okay? And then at the bottom, there's 11 industries at the bottom, and it's who you very well might expect. It's general merchandise stores, it's grocery stores, it's restaurants, and the like. And so, by the way, David, your comment about the decline in earnings at mega firms, it's at the grocery stores and the general merchandise stores and the like. So I listened to this hypothesis, which sounds really interesting, and I ask, is it plausible that the rising cost of healthcare and your hypothesis has this very distinct pattern in a very small number of industries? And I can't see my way through that, but perhaps there is a way you can bring this. And maybe this is related to the comment that was made, is that you did say there's lots of mechanisms that are work. They're not mutually exclusive. And so, interestingly, is to think about how these things interact.
Adele and then Matt Fiedler.
Thank you, and thank you for this very interesting paper. I really like how it sits in the literature of the consequences of not having a proper, well-designed social safety net, as Angus was talking about. And I think there are lots of other consequences that I would just encourage folks in this room to think about carefully. And I think those consequences include inefficient and otherwise bad outcomes in other policy arenas. I'm going to give an example. The U.S. is an outlier in its lack of political support for climate policy, meaningful climate policy. And I think part of that is because we don't have a social safety net that will properly address the potentially disruptive reallocations of economic activity across different sectors. It could be a wrenching change, particularly in some industries, but we don't have the right supportive structure to facilitate that reallocation. And as a result, people don't support climate policy, relatively speaking, in the United States. So we end up with, a system of subsidies and tax credits and stuff like that, whereas we could have much lower cost emissions abatement if we could get to the right kind of policy design. So there might be other areas where, there are these consequences of not, doing our safety net properly that could be quite large in terms of economic or social welfare implications.
Thanks. Matt?
Yeah, just a comment that connects to, I think, some of the other comments. There's a representative firm here. In reality, we know there are firms and the representative firm offers coverage. We know in reality many firms don't offer coverage, and they disproportionately employ non-college workers. And so you would expect that the wage for the non-college workers is to a significant extent being pinned down by those non-offering firms, which may seriously constrain the ability of the offering firms to pass through the cost to their non-college workers. So I think that's a reason, alongside I think some of the other comments that have been made, to suspect that we may be farther from the sort of head tax financing than you'd expect.
Okay, I think that's all the comments. So we'll go back to the authors to respond to the discussants and the group questions.
Okay, I have the benefit of having great co-authors, so I'm going to ask for their help, and I'm not going to respond to everything. So first, thanks, David and Angus, for excellent comments. On the value of insurance, I think one thing that's important to note, we don't need that for the payroll tax counterfactual. It's only the Canada counterfactual where we have to take that into account. The original idea for the paper involved more estimation. So to go to Melissa's comment and also others, initially we were thinking about using regional variation in health prices to see if places that, say, either because of consolidation or because of innovation had higher healthcare costs, and we were quite interested in the amenity value of that. If it's a technological improvement that people value, that would be interesting to see empirically. And or if it's about admin costs, presumably they don't value it as much. And so we were very much hoping to do that, and we invite others to try. So then the third thing is if, as David and Angus suggested, the value of health insurance is pretty low, then economically what this looks like is, there's not as much of an amenity effect. It's really just a tax increase. And, the distortion grows with the square of the tax rate. So as, absent other distortions, which are probably there. So, as healthcare costs go up, if this is the right way of thinking about it, it will get increasingly bad. The second thing about focusing on the firm side that, David emphasized, I think that's quite right. And, the absence of kind of a pathway of job ladders from starting in the mailroom and moving up, I think, this could be one of the reasons why that we don't see that as much. That's speculative, but that was something that occurred to me. I think Angus is exactly right on fixing the CPI instead of PCE. Sorry about that, but I think that was a mistake. And then I'll turn it over to co-authors if they want to say anything else.
Thank you all very much. These are all very good comments. A general theme of all these comments, which I suspect my co-authors are sympathetic to, is this can't be all that's going on, either because it doesn't match, an exact time series, or there's the, between industry facts. We totally agree. The goal of our exercise was to just, get a sense of whether this was potentially quantitatively important and therefore should be studied more. The work that Ann and Angus did, the work that Saez and Zachman did, qualitatively, their point just jumped off the page to us. You just think about shifting, think about those graphs Owen put up. And so our sort of thought was, could this be quantitatively important? And I think our provisional answer, or our answer is yes, it could be. And what we hope very much is, now in all, we joked somewhat among us that our goal for this was, when David Otter teaches labor market inequality, so he's my colleague, so I was thinking of him, we want him to have a couple slides on healthcare and not just on all these other things. So that's just a general comment. More specifically, Melissa, I guess, a selection or treatment we think alike. We actually, one of our many failed ideas for empirical work on this was to look at the Medicaid expansions. In practice, however, the Medicaid expansions took people out of the ranks of the uninsured, and I think much to the surprise of at least some economists, did not change rates of employer offering or coverage. So that was not, unfortunately, from that perspective, not a useful empirical strategy. And then I think in terms of other benefits, other types of which Adam and Eshwar also brought up, I think obviously those are incredibly important. I guess our thought was, take your example of Social Security. That is literally financed as a payroll tax. So it didn't have this same, lump sum per worker element, but definitely something worth more thought.
I'll just add a little bit on a few things because there were so many amazing comments. I think it's pretty clear that discussants like hips better come in pairs. And so I'm grateful to both discussants. The ACA, when it was introduced, did introduce sort of they tried to prevent firms from being able to outsource and then cut off offering to those outsourced workers by saying that if a firm has a sufficient number of workers, say the outsourcing firm, then they have to provide the health insurance. This, of course, does not apply if the outsourced workers are outside the U.S. And so I think some of the industry-specific trends and the types of workers that were most exposed to this over the 20, 30-year period that we're looking at are going to be more of the middle-income, older workers in those kind of higher health cost industries. And so I'm thinking heavy manufacturing specifically. This goes to John's question about which types of industries. I think that's more for the quantities than for the earnings piece. And then for some of the other response margins, that actually means and the quantities of employment are actually pretty important. And then they're also quite important for welfare. So we want to emphasize the quantities piece here. And, in some sense, the earnings data that have been used to emphasize the rising inequality are kind of incomplete. This goes back to some comments about compensation. They may overstate the welfare inequality here, and so we wanted to understand that better. Adam's point that compensation inequality sort of gone up about the same amount. well, there are two offsetting things. This is what David mentioned from Brooks Pierce's paper. So if you just look at the healthcare piece, compensation inequality would have gone up less than pay inequality because the health piece was like much bigger in that middle of the earnings distribution. The offsetting pieces like pensions, 401ks, and incentive compensation that have gone up a ton for reasons that I think are outside the scope of what we're doing here. And yeah, I think the other comments were pretty nicely touched on by others. So thanks so much.
All right. Well, that brings us to the end of the day. I want to thank all of the authors for such an interesting set of papers, the discussants for their remarks, and the group for great questions and commentary. Hopefully we will see you in September. The next conference is September 28th and 29th, so look for this space. See you then. Thank you. This is good. Maury, before he left, said that